U.S. exceptionalism is not going away.
There is an awful amount of good news already priced in.
Investors have been very cautious about missing this.
The earnings power are there.
Estimates for cyclical earnings are most likely too high.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from the nation's capital this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday at fresh records, investors piling into equities, sending the S&P 500 to all-time highs, as TSMC's positive outlook is reinforcing confidence in AI chip demand, and the US and Iran considering a 2-week ceasefire extension. Stocks holding steady, Bramo, so far this morning.
Yeah, and frankly, the rally that we have seen is just tremendous. Bespoke Investment Group came out with a statistic that I thought was absolutely fantastic. Since 1928, this is the first time that the S&P 500 has made a new all-time high in 11 days or fewer after falling 5 to 10%. Just to give you a sense of how big this rally has been and how broad-based, it is not the Magnificent Seven. This is everything. The Russell 2000 is 0.2% away from an all-time high.
It has been absolutely phenomenal. We've talked about it repeatedly over the last week or so. The market reset, a 10% move off the lows for the equity market, a 20% move off the highs for the oil market. There's a feeling this is like April 2020. April 2025, where this market just moves on and looks through the risk and looks through everything on the horizon very quickly.
Well, that's what it's doing right now, because the market is basically pricing in that this war is over, even though yesterday Caroline Leavitt, the press secretary, says they haven't formally requested an extension of the ceasefire. She says this White House remains very much engaged with the mediators. Everyone is expecting that this ceasefire is going to go past the deadline of April 22nd. And at the same time, Reuters is reporting that the Iranians are coming to the table, but potentially saying some vessels can pass through the side of the Strait of Hormuz that goes out to Oman. So maybe on the horizon, we could see more oil flows.
Look at what we've heard from the companies so far. ASML out of Europe, raising its outlook. TSMC, Taiwan Semi, doing something very similar. Bramo, do you see this as confidence in the tech trade or comfort with the risk in the Middle East? Is it one or the other or both?
It seems like it's confidence that economic momentum can continue even though we have the Middle East situation where it is. And it is predicated on the tech trade, on this investment that is existential, that is ongoing regardless of what happens in the Middle East. But it's not just the tech trade. And I think that that's important. And what we heard from the banks is that consumers are resilient in the United States. People want to spend. It feels like as soon as you get the albatross off the neck of the economy that is the uncertainty in the Middle East, even if you just tamp down that uncertainty, you could get a rally. And that is what you're seeing.
Nice to be in Washington to cover the IMF World Bank spring meetings. Hardly talking about it because we're all focused on something else, somewhere else. I just wonder how consumed they are by the physical reality on the ground and how the tension continues to build between the conversations we're having about a better future and the reality in the physical markets in oil. Every time we bring this up, it just feels like doom and gloom. And it feels like we're divorced from what everyone else is talking about. But the reality is we've still got rationing in Asia. There's still the risk that we're going to see the same thing happen in Europe in the next few weeks if we don't reopen the Strait of Hormuz and get that energy flowing once again. And every time we talk about the extension of a 2-week ceasefire and those kind of things, I have one question, and only one question. Does that 2-week extension involve reopening the Strait of Hormuz or not? Because that seems to be the most important thing still this morning.
You have a blockade from the United States, and then you have Iran saying we're not going to let anything through. So it's a double blockade right now, even though you are seeing on the margins some ships start to enter the Persian Gulf, which is a good sign. You're right. And at the IMF meetings, people are coming out and warning about the gloom and doom. You guys are divorced from reality because the reality looks really concerning. And at the same time, people are saying, you're just that nerdy kid in the corner looking at the data. Stop it already. We're looking at how good things are. You guys always worry about stuff. We're moving on. And that dissonance can be felt that much more profoundly this week here.
All-time highs on the S&P 500 and the Nasdaq futures so far this morning, up 0.1%. Coming up this hour, we'll catch up with Max Kettner of HSBC with stocks rallying to all-time highs. We'll speak to General Karen Gibson of Academy Securities on a fragile ceasefire, and the IMF Director of Capital Markets, Tobias Adrian, on risk to financial stability. We begin this hour with stocks extending gains after posting fresh record highs. Max Kettner of HSBC writing, what matters more than geopolitics is what's driving the global earnings outlook. The big question is whether US exceptionalism will make a proper comeback. Max joins us now for more. Max, you've been Max overweight for quite a while. We were talking about it at the top of the program here. Do you see this as comfort with the risk in the Middle East or renewed confidence in the US tech trade?
I think it's probably more the latter. In fact, I think I would argue, does the Iran war really matter that much to the global earnings outlook, particularly to the earnings outlook of the S&P? Bear in mind, when you look at the S&P, you look at US large caps, it's not like consumer cyclicals are 30, 40%. Absolutely not, right? Actually, you look at consumer discretionary, strip out Amazon and Tesla, you're talking about sort of 4.5% of the S&P. And even there, when you link within those, you look at the proper consumer cyclicals, you're talking something like 2 to 3% of the S&P. So even if, let's say, the lower end of the K of the slightly weaker households in terms of household health and financial health, if they are hurt the least, does it really matter for S&P earnings? I would argue no, because you look at tech, you look at the tech sector, you look at the AI sectors. Actually, when you look take in AI together, that nowadays accounts for almost 50% of market cap. So to me, I don't think what we've seen in the last 11 trading sessions is the irrational reaction. I think actually what was irrational was the really sort of the 20% derating and compression that we've seen in S&P multiples at the beginning of the war.
Max, 2 points you made. S&P earnings, S&P multiples. Is the same true of the international backdrop, the global earnings story, the European equity story?
I think on the European earnings story is probably slightly more nuanced. When you look at stuff like chemicals, stuff like autos, they are going to be probably more affected. So I think where we're in right now, we're probably in the sort of global relief rally, not just because of US-Iran, but also because of things like interest rate volatility that have basically more than doubled, right, during March. That's now really, really come down quite a lot, and that helps pretty much everything. Now, when interest rate vol comes down, what helps that the most? That helps really the laggards from March. So what you want to do right now is basically flip the performance picture of March. So my advice to investors is very simple. You just download a performance picture across sectors, across regions, across asset classes in March, and you just flip it, all right? You buy the stuff that didn't work in March, you sell the stuff that did work and protected you. I think in a second stage, the second trade, probably in a couple of weeks or a couple of months, that is probably then more going towards, okay, what's actually changed from the fundamental backdrop? A little bit like with Russia-Ukraine, where on a relative basis, then we're probably talking about, right, the AI outlook, the tech outlook is still strong. So probably then it's worth rotating from Europe to the US, but not right now. Right now, you're still playing that V-shaped recovery trade.
And how much, Max, is this really predicated on the idea that big tech suddenly is once again a haven trade after kind of being kicked around for a couple of months? Are we seeing anything fundamentally different now, given the pressures from higher commodity prices that will pressure certain consumers in some regions more than in others?
Yeah, look, I think I'm not disputing that it will hurt certain consumers, but at the end of the day, our job as analysts, our job as portfolio managers is to look at the aggregate number. We've got to look at the aggregate PCE or retail sales number. What's that driven by? That's not driven by the lowest 20%, right? This is a very cynical thing to say. The lower end of the K that's been struggling already since COVID, that's been struggling even more with, stuff like food prices going up even more than core and headline CPI. They've been really struggling even more. They're now going to struggle even more. Now, from our perspective, does that matter for the PCE or for the headline retail sales numbers? No, they are not the main contributors to that. So therefore, that's why I'm saying, you know what, actually on the headline numbers, there's probably not going to be that awful much of change. And on the tech side of things, I think one thing has fundamentally changed in the last 2 quarters. Pretty much since November, since the Q3 reporting season, we've kind of given up on the AI earnings outlook, right? That was the first time where markets have actually not rewarded, but actually punished higher AI capex. The result of that was flat prices of AI, of hyperscalers, but earnings going through the roof still. And now relative tech valuations, if you look at S&P tech versus X tech or Max 7 valuations, you're close to 10-year lows. So that tech premium has almost entirely vanished. That really puts tech and US on a bit of a longer term perspective on a really, really, I would argue, even cheap foundation now.
Max, I feel like you should change your name from Max Kettner to Max Bullish, because you've been Max Bullish for quite a while, with one huge caveat, which is what the yield backdrop ends up looking like. That could be the fly in the ointment if you see that danger level, particularly with the 10-year yield. There's a lot of uncertainty around the Fed. The poly market trading betting odds now have the chances of Fed Chair Jay Powell leaving the board by May 30th at only 31%. I mean, how much do you see this as a real risk versus just some sort of theoretical risk out there, given the fact that a lot of inflationary metrics have been relatively under control?
Yeah, just to be clear, so we've not been sort of max bullish on equities for a year, and we don't see any risks at all. It was just more in mid-March that we saw, right, probably there's been enough happening now, and we're probably pretty close to particularly systematic positioning, very clean, which is still the case. And that has driven us to that max bullish stance. Am I still going to be that in 3 to 6 months' time? I think that's very questionable, because what you've been asking, I think that is not a theoretical risk. That is a real risk. Because at the end of the day, look, U.S. earnings outlook is really strong. At the end of the day, actually Q1 reporting season, ahead of that, we've now seen the highest negative to positive pre-announcement ratio from U.S. corporates. U.S. corporates are telling us ahead of the Q1 reporting season, things are not only fine, they're even better than they themselves have expected by the most in 5 years. And that really, I think that is something that brings perhaps the danger back, that things are not going sort of Goldilocks, not too hot, not too cold. But then in a couple of months, with sort of sticky inflation and with perhaps the unemployment rate going down even further because of that very low break-even payroll and a really, really solid and accelerating earnings backdrop, that suddenly things are just too good. So I wouldn't pin it on Kevin Warsh. I would simply put it on the data, perhaps in a couple of months, just looking too hot. And therefore, the terminal rate may be having to move more towards 4%. And that, of course, would put pressure across all the asset classes, with the dollar the only safe haven again.
Well, Max, in that situation, could U.S. exceptionalism make a proper comeback? You say that's your third stage in your note.
I think that is then the case. Yeah, I absolutely think that's the case, because right now, what is U.S. exceptionalism, right? It is inflation is sort of sticky, and actually growth is kind of fine and is accelerating. It's particularly the superior profitability, right, against the rest of the world. Now, when you look at something like price-to-book ratios of the U.S. against the rest of the world, and you compare that to the return on equity on a relative basis between the U.S. and the rest of the world, what you will see is that the compression, that relative compression, was way more, significantly more than is justified what's been happening on the relative profitability side. So I do think people have really, really overreacted to some sort of AI funding concern since Q4 last year. And I think that is then when we realize, you know what, maybe the US is, as stupid as that sounds, is even too cheap given that superior profitability outlook. At some stage, I think given that sticky inflation backdrop, given that the top-down growth side also is more than fine, I think in a couple of months, we're talking probably about a bit more of a challenging rate outlook there.
Hey, Max, it's good to hear from you. It's good to see you. Max Kettner there of HSBC on the latest outlook. That's the bull case. Give him some credit. It's been bullish throughout this whole war. Give some credit as well to Venu Krishna over at Barclays, who raised his outlook, his price target on the S&P 500 in the middle of the war with crude at triple digits. And it's been so difficult to explain to people, maybe outside of financial markets and not following this every other day, that at the same time this war has been building and this ceasefire, before it even took place, and the Strait of Hormuz remained closed, we had earnings expectations getting better, not worse. Not the same, but getting better, not worse.
We all were just slightly skeptical when Venu Krishna came in, I will just say, when he raised his forecast. And at the same time, it seems like the rest of the market is catching up to him, because ultimately companies keep coming out and keep beating expectations.
Equity futures this morning positive by about 0.1% on the S&P 500. With an update on stories elsewhere this morning, with your Bloomberg brief, Isabel Lee has more. Morning, Isabel.
Morning, John. At least 2 U.S.-sanctioned Iran-linked ships traveling through the Strait of Hormuz and into the Persian Gulf. The ships may have taken a new route from the UAE, passing between 2 Iranian islands as the U.S. blockade of the strait enters its 4th day. Talks are scheduled today between Israel and Lebanon. According to an Israeli official, the country's prime minister and the president of Lebanon will speak following ambassador-level talks in the U.S. earlier this week. Those were the first discussions between the two countries in more than 30 years. and the Trump administration looking to have U.S. car manufacturers play a larger role in making weapons. The Wall Street Journal reporting the Pentagon approached top executives at GM and Ford about producing military supplies. The talks come as U.S. officials grow more concerned about domestic manufacturing capacity. That's your Bloomberg Brief. John?
Isabel, thank you. Thank you for the update. Up next on the program, a looming ceasefire deadline.
I saw some reporting, again, bad reporting this morning, that we had formally requested an extension of the ceasefire. That is not true at this moment. We've remained very much engaged in these negotiations. These conversations are productive and ongoing.
Up next, we'll catch up with General Karen Gibson of Academy Securities. Live from Washington, D.C. this morning. Good morning. Day winning run on the Nasdaq 100. What a rally we've seen for U.S. tech stocks and for the whole global equity market, bouncing back from the lows of the last few weeks or so. On the Nasdaq, an 11-day winning run, the longest since December 2019. Futures this morning up again by 0.1% on the S&P 500. On the Nasdaq up by 0.3. Lisa, on the Russell, we're up by 0.1.
Yeah, really, to me, the Russell 2000 continuing to keep pace with the S&P 500 indicates that people don't just believe this is a tech story, even though it is going to be fueled by AI investment. It is a broad-based beating expectations across the board with a consumer that's resilient, and that is the story that people are clinging to.
So we turn to crude. We've moved on. I still check it first thing every single morning. I'm not sure if anyone else still does. We're still in the 90s, and there's still this massive disconnect between the physical market, where things are really, really tight right now, Annmarie, and the paper market. The front month of the futures curve, 96 on Brent, WTI at 92.
Nothing has actually changed in the physical market. Actually, you can argue things are getting worse in the physical market. I saw that one country in Asia actually only received half of a full tanker because they were so desperate. They said, bring whatever you can. That's the story in Asia, and then potentially it's going to get a little bit worse in Europe. But right now in the United States, we're semi-insulated. It is incredible to see the facts not changing on the ground, but yet the futures facts are changing. And they're just not pricing it in because they're pricing in peace.
Brent crude, 96.26. Under surveillance this morning, a looming ceasefire deadline.
I saw some reporting, again, bad reporting this morning, that we had formally requested an extension of the ceasefire. That is not true at this moment. We've remained very much engaged in these negotiations, in these talks. You heard from the vice president directly and the president this week that these conversations are productive and ongoing, and that's where we are right now.
So here's the latest this morning. The US and Iran reportedly looking to extend their truce for an additional 2 weeks. Bloomberg's Tyler Kendall joins us now from the White House for more. Good morning, Tyler. What's true, what isn't true, and how close are we to extending this ceasefire?
Hey, John, good morning. Well, if we piece through the details, we can say that the White House at least says that these negotiations are ongoing, but at this point, no formal confirmation here that we're going to see an extension or even another round of in-person talks. Though White House Press Secretary Caroline Leavitt did go on to say that the U.S. feels good about the prospects for a deal, and also added that as Pakistan remains the main mediator in this conflict, we could likely expect Islamabad to host the next round of in-person talks if and when they happen. Plus, pair that with comments from Pakistan yesterday that a delegation had arrived in Iran in a bid to try to keep this momentum going, because Bloomberg News is one of those outlets now reporting that we could see this 2-week extension. And we have a little bit more of those finer details, including that this extension would be geared towards letting negotiators at the technical level try to make some progress on the big sticking points before senior officials actually get back to being face-to-face, because at least publicly the sides still feel very far apart on some of those main points. Just yesterday, we heard from Iran's foreign minister saying that Iran's use of nuclear energy cannot be revoked, though he did seem to suggest that the level and type of enrichment may be up for negotiation. But still, that's testing this White House's at least public red line of no nuclear program. Then, of course, the issue of now the double blockade when it comes to reopening the Strait of Hormuz. And John, yesterday, the White House did detail that's not the only tool of economic pressure they would be willing to use. U.S. Treasury Secretary Scott Bessent saying that the U.S. is renewing efforts to work with Gulf partners on freezing additional assets of Iranian leaderships in their banking systems, and threatened those secondary sanctions on any financial institutions that help the country.
Tyler, we'll let you go. That sprinkler behind you is making me nervous. It's just coming around at the wrong time. No? You felt the same thing?
Well, I just love the lawn work that we get.
Always
every single in the morning. I mean, we should have all these clips.
6:15.
Back to back of all the lawn work.
It's
in the White
because
House.
the press secretary saw some bad reporting. So you turn the sprinklers on very quickly. General Karen Gibson of Academy Securities, you think I'm joking, maybe I'm not, writing each day that the Gulf remains closed to business, increases risk to the global economy. Iran benefits from a closed Gulf. We do not. General Gibson joins us now for more. General Gibson, good morning.
Good morning.
And welcome to the studio here in Washington. It's good to see you. Let's talk about the risks on the ground right now, the state of the ceasefire and the state of the blockade. What's your assessment of things?
So the ceasefire is holding, which is a good sign. Establishing the ceasefire was a positive step by stepping off that escalatory kinetic ladder that we had been on. And an extension of a ceasefire, I think, is a sign that perhaps there's some productive dialogue going on in back channel. If it were increasingly frustrated, we would probably see an additional bold action by the United States. In terms of the blockade, I think that's a very bold move, an attempt to decline or decrease some of Iran's leverage and to deny them revenue, whether that's from the toll that they exact on passage of vessels or from their own exports. And ideally, that will bring them to the table to make additional concessions. I have no doubt about the U.S. Navy's ability to execute this mission with the same kind of competence, professionalism and precision of all the missions they've performed throughout this campaign, but it does not solve the transit problem of vessels that remain stuck in the Gulf.
Well, in the past, we've seen the Fifth Fleet escort tankers through the Strait of Hormuz. Can we see that?
That is certainly possible. It's another feasible option. It's resource intensive. And so now there is another carrier, as I understand, steaming towards the Gulf. Both the blockade and escorts are resource intensive. It's not just the ships that are escorting them, destroyers, fighter cap, combat air patrol, intelligence, surveillance and reconnaissance, minesweepers. And even if we are escorting vessels, particularly if we're the only nation that's doing it, we can't escort the same number of vessels that previously were flowing through the Gulf prior to this conflict.
So the volume will be low. But if the U.S. Fifth Fleet were to do this, when could they actually start doing it?
I think if they want to impose both the blockade and escorts, we'd probably want to wait for the arrival of the additional carrier strike group that, as I understand it, is on its way there. I think it's important to note, though, that Iran's ability to choke off the Gulf is very broad. It's really based on a perception of risk. It doesn't take a lot of resources on their part. It's not hard to drop a mine or two, or even to say, we've dropped mines over here, and then someone has to verify it, demonstrate the feasibility of sailing through there. And the decision to flow through the Gulf, as you know well, it's not a military or a political decision. It's an economic decision based on commercial risk.
Unless there is a transformation in terms of the way that trips transit through the Strait of Hormuz, will things ever be the same again because of this perceived risk that is now in the forefront of every shipping company's minds?
Yeah, I think perceived risk is exactly what it boils down to. And so there's much that must happen to lower that perception. The ceasefire is an important step because right now we don't see anyone, taking any hits from drones and missiles, et cetera. Also, progress on the diplomatic front would be an important confidence builder. But this period of risk, or this perception of risk, extends beyond shipping. We've seen strikes against airfields, against, Dubai. There's much that will need to be done to lower that temperature across the region. And I know that our Gulf partners are very interested in seeing this resolved so that they can resume a normal commercial environment.
I think we all want to see the same thing, Lisa. Just how close are we to a diplomatic breakthrough? I think it's an important question. And are we just getting a one-sided serving of verbal intervention that implies things are better than they actually are in the negotiations?
One of the reasons why people are getting confidence is because even Iran has said that they're coming to the table, although they're also battling their internal PR battle, given the fact that people don't want to see that in the Islamic Republic. You are correct. How much is this a jawboning game that is one-sided as well and asymmetric in the same kind of way?
It's certainly been effective. Let's put it that way. General, thanks for being here. Thanks for making time for us. Thank you. That was General Karen Gibson of Academy Securities. Up next on the programme, we'll catch up with Bob McNally of Rapidan. With energy shortages looming, we've seen this story building across Asia. Is Europe up next? That conversation just around the corner. Live from the nation's capital this morning. Good morning to you. Equity futures so far this morning on the S&P 500 shaping up as follows, following a 3-day winning streak on the S&P and a 10% plus rally off the equity market low from the end of last month. We're up another 1/10% on the S&P. On the Nasdaq, 11-day winning streak. We haven't seen one of those since 2019. Can we make it day 12? Which just sounds absolutely ridiculous. The Nasdaq 100 up by 0.25%. Renewed enthusiasm for the tech trade. But Bramo, as you've pointed out repeatedly over the last 30 minutes or so, it's not just about U.S. tech.
Yeah, we're also getting reports from the likes of Pepsi beating expectations. Even consumer discretionary is coming out and exceeding expectations. I mean, heck, even a sneakers company is becoming an AI company. So all of a sudden, everyone can rally. But ultimately, you keep getting these beats and a sense from the big banks the consumer is still strong and that, yes, higher gas prices might hurt, but not enough to really eliminate this resilience.
You want to go there?
I do.
You went there, so let's go
Okay.
there. I mean, Allbirds, I guess is what you're talking about.
Is there another one?
It's the first one. There might be others based on that stock move yesterday. Yeah. This has echoes of what we saw with the crypto craziness. What was that, 2017, 2018? Yeah. That period where people started renaming companies and putting blockchain in the title to get the stocks to rip, and it was effective then, and I imagine we're going to see more of the same this time around.
I feel like Overstock was the perfect poster child of that when they came out and this furniture company was talking about how they really are a blockchain company. Now, if a sneaker company can be an AI equipment company, are we reaching the same kind of fervor?
Long Island iced tea, wasn't that?
Oh,
it?
That's right. That was so good.
Yeah. Good times.
Actually, blockchain.
Good times. Nasdaq futures up by 0.2% so far this morning. Should we turn to the bond market? Check it out. So we've had a 10% move off the low in the equity market. And in the oil market, we've had a 20% move off the high. In the bond market, things just a touch snoozier. A 15 basis point move off recent highs on a 10-year bond yield this morning, down by about a basis point. Lisa, 427.56.
Yeah, ultimately, the bond market has been beset by dueling ideas here. On one hand, you've had inflation that's been coming in hot. On the other hand, it's going to dampen some of the consumer resilience, so that might take some of the heat out of the economy. Are we looking at an inflationary shock or the disinflationary shock that we had before this conflict that could allow the Fed to cut rates? And then, of course, there's a drama on the Fed.
Now, the drama elsewhere as well is also in the oil market. So it's that time of the morning, that time of the program, where we turn to crude. And we sound completely divorced from the enthusiasm taking place elsewhere when we point out that Brent's still trading at 96, WTI's at 92, and the physical market's still a mess.
Yes, it's still a mess. The strait is still closed. There's a few vessels that are getting through, but nothing like the volume we've seen in normal times. Remember, there's a blockade on a blockade. Yes, we have a ceasefire. They're thinking about extending it. But to do that, we would need to see at least one of the demands from the United States that the Strait of Hormuz be open. What Iran is offering now, according to Reuters, is just that they allow some vessels to go through the Gulf of Oman. That's not a full flowing of oil that we've seen before this crisis started. But when you look at the futures market, they're basically just shrugging off the physical pain we are seeing in Asia. And it is real when you look at people working from home and what they're doing in organizing timed blackouts. It is serious pain for a lot of people in Asia, and that's just going to be moving to Europe. Not yet in the United States.
Brent crude 96.44. On our radar this morning, the US and Iran moving closer to a ceasefire extension. Mediators working through the main sticking points, including the reopening of the Strait of Hormuz and the future of Iran's nuclear program. Elsewhere, the Pentagon approaching US car makers about playing a larger role in weapons manufacturing. The Wall Street Journal reporting US officials are holding talks with top executives at GM and Ford about producing military supplies. And finally, the CFTC investigating a series of well-timed and profitable bets around President Trump's military decisions in Iran and Venezuela. The agency looking at instances of surging trading volume and requesting data from exchanges.
And this comes after widespread speculation and criticism about who is making money and profiting off of information that might be leaking ahead of this. We heard from the CME is any review of market behavior must include all venues, including prediction markets like Polymarket and Kalshi, because there has been a lot of speculation around those as well. There has been this underlying feeling, why would you play ball at a time when somebody else has an inside hand? And ultimately, that has been speculation time and time again. It's important to really unveil that and get a true answer.
And it doesn't help when it comes to speculation when this White House felt the need to send out an internal memo reminding people not to trade off of information you are finding out working at the White House. Interesting today, the CFTC chair will be speaking at Agricultural Committee, giving testimony in Congress. this is, of course, going to come up.
You want maximum transparency, and you don't want to feel like someone else has got an edge that you don't have, not because they worked harder than you, but because they have access to information that other people don't have. This is something we have to address. I would say it goes beyond financial markets as well. I think it goes to betting markets too, and that's something on everyone's horizon based on the last few months.
It reduces liquidity. It reduces market free trade because ultimately people want to see that fair playing field. Otherwise, why would they get involved? So you're absolutely right. And how many people did we talk to? This isn't a tradable market because ultimately, what edge can you get unless you have an inside line?
And this is becoming a political issue, not just for the midterm elections this year, but for 2028. Rahm Emanuel, who was the chief of staff for former President Barack Obama, he's mulling whether or not he's going to run. He doesn't think anyone that works in government should be able to trade, or their families, on Poly Market or Kalshi or any of these sort of prediction markets. Liquidity
is the issue here, and Lisa brought it up. If you believe something fishy is going on here, are you willing to deploy capital to these markets in the same way? And if you're not, does that disrupt the amount of liquidity in markets on any given day? Now, that's why we like U.S. financial markets: deep, liquid, transparent, information, nothing hiding. Maybe I'm talking a little bit too rosy about financial markets in general, but ultimately, that's the benefit of U.S. capital markets. If you do something to sacrifice that because you want to get a small gain ahead of the president and a declaration he's about to make, that's something they need to take really seriously, and I'm pleased that some people are.
You know, I wonder how much the recent kind of shrug that the market is giving to a lot of the headlines is because of this. Why should anybody be taken for a ride on whipsawing headlines or extreme prognostications, given the fact that in the past, they've been on the losing side every single time? Again, fool me once, shame on you. Fool me twice, shame on me. And I got it right again for a second time.
3 for 3, Bramo.
I mean, that was a repeat, though. I'm really trying.
I was holding my breath. I was holding my breath. Can she do it?
Down. All right, let's go.
You've been practicing.
Every night in the mirror.
So impressed.
Thanks.
Equities right now, the S&P, just about unchanged on the S&P 500. Crude edging higher. And gas prices still elevated with the Strait of Hormuz all but closed. The Treasury Secretary, Scott Bessent, saying lower fuel prices should be on the way.
I'm optimistic that during the summer we will see gas with a 3 in front of it sooner rather than later. I'm optimistic that sometime between June 20th and September 20th that we can have $3 gas again.
Bob McNally of Rapidan Energy Group expecting a prolonged Hormuz disruption, writing, if the Strait does not reopen by 3Q, we estimate the oil price rally will likely need to be capped by extensive demand destruction in the form of severe hits to GDP growth. Bob joins us now for more. Bob, welcome to the show. I wonder if you share that enthusiasm and confidence of the Treasury Secretary for lower gas prices in the months ahead.
Well, good to be with you. You know, our base case is that we will avoid that worst case. Recession caps the oil price spike. It's how it's been done in the past. But we're cautiously optimistic we will get to a better outcome, not right away, but we will have either a ceasefire in the coming weeks that allows a full resumption of Hormuz flows, or the U.S. military will get on with the job of degrading Iran's ability to interrupt shipping in the coming weeks. That may take a little longer. But I'm cautiously optimistic we maybe see the end of the oil price rally, hopefully before it has to come to recession. However, gas prices, that's another story. We have to see how things turn out this summer. I hope maybe by the end of the summer to have a 3 handle, but that would be optimistic.
Bob, Reuters is reporting that Iran could consider allowing ships to safely go through the Gulf of Oman. How would that affect flows? How many more vessels could we see actually then start to move?
Well, in the old days, before this, the way out, we go through Omani waters, and the way in through Iranian waters. They kind of split the highways, if you will, the TSSs. And I think, you know, if it's just Omani waters open, it's not clear we can get back to a full and safe restart of flows, possibly. But I think what Iran is really signaling here, and it's more important, is that it realizes, and this is very important and very hopeful in the long term, it realizes no one's going to let them be the toll keeper of Hormuz in the long term. They did move and play the oil card. I don't think the U.S. expected that. And because they have this leverage, they have stronger ability to extract concessions from the United States on nuclear and other things, and they probably will. However, they realize the Gulf Cooperation Council countries, Israel, the United States, there's no way we're going to allow them to choke this thing forever. So I think it's kind of an admission that, yeah, we know at some point flows are going to resume. Whether it's through totally Omani waters, we could do that if we had to, or back to the old ways, partially Iranian, partially Omani. But it's going to come back to freedom of navigation eventually.
The president yesterday was talking a lot about his conversations with China on his upcoming trip to China. Right now, I know China's taking in much less crude from the Middle East, about halving what's going on in terms of what they used to import from Saudi Arabia. How are they dealing with the problem right now? Because I know you have a new note right now actually talking about how China is going to weather this storm.
So China stocked up well. I mean, they're not enjoying it, but they're doing better than many of their Asian neighbors. They had 1.2 billion in crude inventories. They've been hoarding like mad. Other commodities as well. They're going to begin to draw those down. They're dropping runs. Again, they're in a better position than many of their neighbors with regard to this famine of oil that is now certainly in Asia. So with regard to the loss of the 1.6 or so they were getting from Iran, I think we expect more stock draws, more run cuts. No fun, but it's not a disaster. But I just step back and say this. I think this whole Iran and China link is overstated. China has much more going on with the other side of the Gulf and the Gulf Cooperation Council countries in terms of economic and financial linkages, and the relationship with the United States is very important. It's got big agenda items on trade, chips, and other things, Taiwan. And so, you know, I wouldn't overstate how tight that linkage and that relationship with Iran really is with China, and they're dealing with it, you know, pretty well. I don't think they're going to militarily challenge our blockade. I think they understand this is not about China, it's about Iran. And so I'm optimistic that the China aspect of this can be managed pretty well.
Bob, what are you looking for to understand whether the blockade could get removed, and the first blockade could get removed, and then the second one could get removed, and we could actually get free flow in some form or another in the near term?
Well, I don't think the blockade is going to be removed, the U.S. blockade on Iran. Indeed, it looks like it's being expanded this morning to allow checks for ships that may have contraband or weapons, and nuclear weapons and so forth. So if anything, it's expanding. So I think, look, there's going to be a big deal at some point, and there'll be resolution on nuclear, on missiles, on proxies, on giving Iran some of its money back, et cetera. And that'll include the Strait of Hormuz, and we'll be lifting a blockade. We don't think we're there yet. Unfortunately, we think this has to get worse before it gets better. But at the end of the day, I think there's going to be a settlement of all the issues, and we'll see a lifting of blockades being imposed by both sides. And we have to hope that by then we will not have seen extensive destruction to physical infrastructure, which would prolong the recovery in flows beyond the 3 to 4 months we're already looking at.
Robert, always good to catch up with you, sir. Appreciate your time. Bob McNally there of Rapidan Energy Group on the reality in the oil market. And it's not a great reality in the physical market right now, but we talked about this countless times. Companies keep delivering results. I remember a line from Savita Subramaniam of Bank of America, which he uses repeatedly: never underestimate corporate America. And we've seen that from the financials all week. BNY reported just moments ago, and they've done exactly the same thing. Record revenue, double-digit growth, net income up by 36% year over year. The stock is up in the pre-market by something like 0.8%. Since Robin Vince took over this bank, back in 2022, the stock is up by more than 200%. Now, I'm not just mentioning that because that's a Brit in charge of a US bank, but he's had a phenomenal run at this institution. And it's another example, Bramo, of another company getting it done in America at a time where there's a lot of stress elsewhere.
Yeah, and if there are any Brits running American companies who want to reach out to John, I recommend that they do so. Look, I do think that this really highlights two things. Number one, execution, and you are seeing a number of large firms actually execute pretty incredibly so far this quarter. I think it also speaks to the liquidity and just how much cash a lot of investors have. And people keep coming back to this as also one of the hallmarks of resilience. There's just so much cash that needs to go to work. I mean, the idea of scarcity of bonds that we hear about from Bob Michael over at JP Morgan Asset Management. You're seeing that in the results from asset managers and big banks.
Stock up in the pre-market by 0.8%. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Isabel Lee has more. Hey, Isabel.
Hey, John. Taiwan Semiconductor is hiking its revenue outlook, now forecasting 30% growth for the year. The chipmaker saw profits surge as AI demand remains resilient despite global instability. Executives did offer a word of caution, though, warning that the conflict in the Middle East could eventually squeeze margins as shipping costs and energy costs continue to rise. China's economic growth rebounded more than expected in its first quarter, suggesting less spillover from the Middle East war so far. The growth was boosted by strong manufacturing and exports, but consumer spending and private investment eased. And PepsiCo shares rising in pre-market after reporting earnings that beat on the top and bottom lines. The company saying it's seeing improvement in salty snacks volume following recent price cuts. PepsiCo also announcing an overhaul of its Gatorade brand. That's your Bloomberg Brief. John?
Isabel, thank you. More from Isabel in about 30 minutes' time. Up next on the program, energies, ripple effect.
The biggest risk continues to be that inflation gets imported around the world again through the energy complex. That becomes challenging. That queers the cost of capital, and effectively then you start talking about the R word.
Up next, we'll catch up with the IMF Director of Capital Markets, Tobias Adrian. He joins us in just a moment, live from Washington, D.C. You're watching Bloomberg TV. Equity futures on the S&P just about unchanged on the S&P 500 so far this morning, holding steady after posting new, fresh, all-time highs on the S&P for the first time since January. On the Nasdaq, an 11-day winning run could become day 12. Equity futures on the Nasdaq this morning up by 0.05%. Under surveillance this morning, energies, ripple effect.
The biggest risk continues to be that inflation gets imported around the world again through the energy complex, and then eventually it works its way through the food and general living ecosystem, and that becomes challenging. That queers the cost of capital, and effectively then you start talking about the R word. The good news is we're not talking about the R word.
Very cool conversation with Ted Pick of Morgan Stanley together with Bramo just yesterday. Catch the full conversation out on Bloomberg.com and on the Bloomberg terminal. Here's the latest this morning at the IMF World Bank spring meetings. The IMF cutting its growth outlook and warning of major risks should the war persist. The IMF Global Financial Stability Report writing the global financial system is confronting several channels through which market turmoil could escalate into financial instability. Tobias Adrian, the IMF Director of Monetary and Capital Markets, joins us now for more. Good morning, sir. It's good to see you.
Good morning. Very good to be here.
I was just recalling a phrase from the Bank of International Settlements from more than a decade ago, and that was uneasy calm. And I think that phrase, uneasy calm, maybe captures this moment quite well. Do you agree?
Well, when we look at markets, there's certainly a lot of risk appetite in markets that has come back. Over the past 7 weeks, we've seen an ebb and flow in terms of this risk appetite. Our own assessment is that risks continue to be tilted to the downside.
Well, this is a strange thing, right? So risks have continue to be tilted to the downside, and markets are hitting new all-time highs. People are moving on as though this doesn't exist. I mean, how do you understand that from a sort of animal spirits point of view, and where there could be potential systemic risks that are developing?
Yeah, that's a very good question. So the way that we look into the future is by considering 3 scenarios. A reference scenario that is relatively benign, where the inflationary shock is somewhat temporary. An adverse scenario where the inflation shock is more persistent and many central banks would have to act. And then a severe scenario where financial stability problems would start to play a role. And looking back again over the past 7 weeks, you can imagine that sort of like the relative likelihood of those 3 scenarios was shifting over time as the news flows was hitting markets.
At the same time, it seems like there are a number of economies, particularly in Asia, Southeast Asia, that don't have enough money to acquire physical crude right now. And so they're having the shutdowns, they're having some of the restrictions on commercial activity. Given how tenuous the financial position was to begin with in some of these nations, how much does it set back by decades some of the countries that had made progress?
Yeah, that's a very good point, right? When we look across countries, there's a huge variance in terms of how hard countries are hit in terms of pricing and in terms of the oil supply shock. So it's the more vulnerable countries, whether that's vulnerable emerging markets or developing economies, those are disproportionately hit. as the share of energy consumption and food consumption is much higher relative to advanced economies. And of course, many countries are importers of oil, importers of gas, and that is particularly challenging for them.
You know, it's strange. It seems like, yes, there's an uneasy calm and there's a war going on that's really threatening supply chains. But the atmosphere this year at the IMF meetings is actually significantly better than it was last year. Why is that?
So, as you pointed out at the beginning, there is quite a bit of hope that is around. Though when we look back over the weeks, there has been a back and forth, right? Volatility has come up at the moment. The VIX is, below or at about historical averages. But we have seen spikes as well. So, let's see how we evolve.
To Lisa's point about what's going on in Asia, Bob McNally was just on. He said it's a famine when it comes to energy. Is that going to hurt capital flows into these countries?
So we have seen a withdrawal of portfolio flows out of emerging markets that is significant, right? Compared to 2022, it's about double in terms of outflows. But the price action remains somewhat contained. So spreads have widened, both hard currency and local currency spreads. But relative to the flows, it remains a somewhat benign scenario.
Is there something about this situation that risks amplifying existing vulnerabilities? We talk often about private credit. Do you see a connection between the two things at the moment?
Yeah, so there are a number of vulnerabilities that, taken in isolation, seem manageable. But if all the vulnerabilities come together, it could become uncomfortable in a severely adverse scenario.
Do you think that's likely?
We think there's some likelihood on this severe scenario, but it's certainly not our baseline.
It's certainly not appreciated right now in financial markets in general, with equity markets at all-time highs at the moment on the S&P and the Nasdaq this morning.
And frankly, if you listen to the rhetoric from a lot of the bank CEOs, none of them seem to think that private credit is a real systematic threat. In fact, they're all investing and broadening out. And what Ted Pick said yesterday was, it's a credit issue. It's not just private credit. And if the economy is going gangbusters, guess what? Credit does well. Ultimately, it seems like everyone feels better this time this year than at the same time last year, even with no oil or anything else getting through the Strait of Hormuz.
There was a line of questioning in your TED Pick interview that I thought was really, really important. The point you made about capital markets activity benefiting from volatility, but deal-making and advisory fees have still held up. That's a strange mix. You think about volatility and you think that would upset the latter. That didn't happen last quarter.
It was headline volatility, but it wasn't directionally negative. So it was good volatility for banks because people were motivated to shift around, particularly on single names, but they still got deals done. So it was kind of a perfect mix that really led to an incredible results from the big banks.
This headline coming from AP just moments ago, speaking to the IEA head, saying Europe, we talk a lot about this cushion, Europe has maybe 6 weeks left of jet fuel. That headline crossing just moments ago.
This is what Asia's been dealing with, and now the next stop is going to be Europe. And also what Fatih Birol, the head of the IEA, speaking to the AP, says, warning of possible flight cancellations soon if these supplies remain blocked, given what is going on with the Strait of Hormuz.
Not good. Tobias, it's good to see you, sir. Thanks for being here.
Yeah,
thank you very much. Thanks for making time for us. The IMF Director of Monetary and Capital Markets. Up next on this programme, we'll catch up with Chaudhuri of BlackRock, Doug Rediker of International Capital Strategies, the Barclays CEO, CS, Venkatakrishnan, and the former New York Fed President, Bill Dudley. The second hour of Bloomberg Surveillance just around the corner.
The economic data has been a bit mixed.
The top 20% of earners basically determine success or failure for this economy.
People are overplaying the K-shaped economy.
We need to see some continued resilience.
Consumers will remain resilient.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from the nation's capital this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action looks like this. All-time highs coming into Thursday, and we add some weight to that rally, up 0.1% on the S&P 500, up 0.2 on the Nasdaq, following an 11-day winning run, leaving behind the fear of March, embracing some tech enthusiasm and a whole lot more.
Yeah, and what you would have today, if we have these gains continue, it would be the longest streak, 12 days, going back to 2017, given the fact that people are looking to what we heard from Max Kettner looks cheap in terms of the discounts that you've seen on some of the Magnificent Seven, and frankly, the tech spend that just keeps on going.
The outlook for earnings has improved. Yes, I know it's difficult to get your head around, but throughout this war, 6 weeks of it, earnings expectations have been improving, not deteriorating, and that's been a major feature, a major dimension of anchoring the bull case over the last month or so.
I would argue it just sort of underscores how much we were underestimating the strength of the U.S. economy during the first quarter heading into the conflict in Iran. How much would the economy have surprised to the upside had there not been this extra cloud when it came to higher oil prices? And what you're seeing is a number of the pillars of this economy seem somewhat divorced from what's going on with Iran, from commodities, because it is an existential spend to build out AI. And frankly, consumers still have jobs, and so they're still spending.
Regaining confidence in the US tech trade is not exactly the same thing as getting comfortable with the risk in the Middle East. And I'm not sure anyone's really comfortable with what's happening right now. It's an uneasy calm. We talked about that about 10, 15 minutes ago. I would say an uncomfortable calm. Given the deadlock we see between talks between the US and Iran, there's a conversation about extending the ceasefire. There's still a blockade. The Strait of Hormuz is still closed. The physical market is still very tight. And in crude right now, we traded the 90s on WTI and on Brent crude. Sub 100 might bring you some comfort, but I can't take a load of confidence away from what's happening in a very, very tight oil and oil product market on the ground right now.
Absolutely. For the real world, this is dire, as Bob McNally just said, and the IEA is coming out saying that Europe maybe has 6 weeks of jet fuel left. Executive Director Fatih Birol says in the past there was a group called Dire Straits. It's a dire strait now, and it's going to have major implications for the global economy, which is why I feel like a Debbie Downer when you look at what's going on in the equity market and actually how depressed the oil market is right now when it comes to the paper market, because the physical market is so challenged.
Mark Knopfler, lead guitarist. Best guitarist ever, Sultans of Swing. One of my favourite songs.
Well, Bob McNally, plays in a band.
Dire Straits, just that makes sense.
But this is from Fatih Birol. But all those oil people, they all talk. They're all invited to Bob McNally's band.
That makes a lot of sense. I play that song every morning coming into work.
Do you?
Yeah.
That's the pump-up song.
Hey?
That's the pump-up song.
That's not quite a pump-up song, just a chill song. I like to stay
in.
mellow. Anyway, coming up on the programme, Gagi Chaudhuri of BlackRock, with equities hitting fresh record highs. Doug Rediker of International Capital Strategies as the US and Iran move closer to extending the ceasefire. And the Barclays CEO, CS Venkatakrishnan, as the war's energy shock ripples across Europe. Looking forward to that conversation with Venkat later on this morning. A question about the Middle East, sure. Trading, capital markets, all that stuff. They're at a quiet period, so they're not going to say too much about earnings. I want to know about Mythos and their access to that tool coming from Anthropic and whether it's the real deal in their mind, because I've been struggling with this, not just over the last week, but for much of this year. How much of the fear stories coming out of this industry, marketing for the IPO roadshow, and how much of it is the real deal?
And frankly, we've heard some of both. I mean, clearly the Treasury Department is taking it really seriously. So far, all the big banks are saying Mythos is our friend. And actually, this highlights how much we can get ahead of any kind of cyber threats. And we are embracing this AI technology. The degree to which they are shaking in their boots about what kind of threats they could be getting from cyber criminals, we don't see that in those earnings calls.
The Barclays boss coming up a little bit later this hour. Looking forward to it. We begin this hour with stocks pushing higher following a record-setting session. Gagi Chaudhuri of BlackRock writing analysts have revised S&P 500 earnings estimates upward by 2% over the past month. However, the outlook is not completely rosy. Gagi joins us now for more. Gagi, welcome to the programme. What a move. Blink and you miss it. It looks like the return of US exceptionalism. Is it that or something else?
Good morning. It's great to be here. Thank you so much for having me. So, I was looking through my notes, and the last time I was here, one of the things that we had discussed was just this idea that historically markets have looked through geopolitical shocks. And I think what we're seeing right now is exactly that, but with one added caveat that as opposed to sort of the Liberation Day movements when earnings expectations went down during that period, what we saw in this last month of March was valuations reset and clients actually racing to take the opportunity to get back into those cheaper parts of the market and really focusing on tech and AI, which is where we saw most of that value be created.
Gagi, let's talk about that value creation. When we sit here and say earnings expectations improved throughout this crisis, where have those earnings expectations actually seen the greatest improvement? Is it just an energy story, or is it in another sector, in more sectors than just one?
Absolutely, and that's actually a very important point. So when you look at how the earnings expectation improved, it certainly obviously did in the energy sector. But it was quite concentrated outside of that in tech, actually. It wasn't broadly across every sector. We saw it in tech, we saw it in communication services, obviously in energy. And then outside of that, things remained, quite muted. So I would say as we go into this earnings season, as opposed to every other time when there is a revision lower and then you beat earnings expectation this time around, I think the bar is a little bit higher. Obviously, we've seen this move. We've seen this value creation. We're seeing tremendous amount of inflows. These are all good things. But I wouldn't be too complacent. And I do think all of the earnings expectations that have been revised higher, we have to see that realize. And obviously, we're watching tech very closely. And we're telling investors, go back to focusing on that AI theme, on that tech, on that growth part of the economy.
If you have all of these companies that are beating expectations, raising forecasts, a consumer that's strong, and you have a lessening of some of the tensions in the Middle East, then how much do inflationary pressures really start to kick in, especially if commodity prices are just persistently higher for the foreseeable future?
Absolutely. So this is something that, I've been pointing out. We've been telling clients that this is a good time to add some inflation protection to your portfolio. We've been recommending STIP, which is sort of the 0 to 5 year part of the curve. One of the benefits in having that is you're tied to headline inflation, which obviously, as you said, Lisa, is going to continue to move higher, at least in the short term, while at the same time, we saw some encouraging signs in the CPI data last week, where at least some parts of shelter inflation are moving lower. If you look at the 3-month, the 6-month annualized data for shelter inflation, that is below that 3% level, which allows the Fed maybe to at least stay on hold. So certainly think about ways in which in the near term, maybe the 3 to 6 month period, that you can add some inflation protection, whether that's through tips or whether that's through a broad basket of commodities.
Gargi, I'd love to get into investor sentiment with you and just get a sense of the psychology over the past couple of weeks. We were talking earlier about this perception that it was an uneven playing field during headline roulette and that some people had an edge. And how do you get an edge when you get in? And there was this paralysis among investors. Why should you trade if you're likely to get your face ripped off, given the fact that somebody else has a disproportionate amount of information? Do you feel like there was a freeze over a lot of the activity that seems to be softening, thawing out, as we can move on to fundamentals and things like earnings?
It's a great point. So the two things that we watch when we're looking at what investor sentiment is doing, the first is we actually poll our clients. We have weekly calls with 1,000 to 2,000 clients joining. We ask them how their investor sentiment, how their risk sentiment is. And we saw that take a dip. And what that meant was they were staying invested. To be clear, no one was selling at the lows. They were staying invested but not adding. Over the last week, that has picked back up to the highs. So it is turning as some of the headlines around hopefully a more durable ceasefire come into play. The second thing we look at is absolutely around flows. Where are the flows going? And again, over the first couple of weeks of April, what we're seeing is in fixed income, the flows are moving away from cash-like products to some more risk on products. And then within equities, we had the best 8 days in equity flows into especially U.S. equities. And then lastly, I'd say people are coming back to EM again, which is now being viewed more as an AI story, with 46% of IEMG focused on tech and comm services.
But so much of part of EM is in this world where they are in dire need of energy. How does that make any sense?
You bring up a good point. Absolutely. I mean, EM, we can't paint that with one brush. There are commodity importers, commodity exporters. But if you happen to look at a broad index, such as the one that I just mentioned, IEMG, what you do find is how much that has changed in composition over just the last decade. On top of that, if you look at where earnings growth expectations came over just the last month, EM earnings got revised actually even more upwardly higher than US. So investors are paying attention to that earnings revision and expected earnings growth in EM. This is related to Korea. This is related to Taiwan, which obviously is in the heart of the memory and compute demand. And we're beginning to see that in broad EM. Now, obviously, there are parts of EM which don't have the memory and the chip associated with it and are also energy importers. And I think that's certainly going to continue to struggle.
Is there like a statute of limitations on this? Neil Dutta writes about this. He goes, either markets are dumb or the oil analysts are. You mentioned things like the hyperscalers, TSMC. They were great today, but they are still monitoring how much helium they're going to be able to use because of what is going on in Qatar and given the Strait of Hormuz. Is there a statute of limitation to basically how high and the earnings expectations for the equity market?
You know, I think what's happened over the last sort of 7 or 8 days is that equity markets have started living in the future. They're looking at growth expectations. They're looking at earning expectations. Equities always live in the future. They're the longest duration asset. Oil markets and oil analysts are obviously showing us that the risk isn't quite over yet. And there is likely to be continued security concerns, energy security concerns, which should be certainly one thing that we leave this with after the end of the war. Hopefully that's coming soon. One of the things that investors should all be thinking about is how do I get energy security in my portfolio, because that's something that's going to stick with me. So I think equities focusing on the earnings revisions that we talked about, and obviously with the expectations moving to 12, 13%, that's what's driving some of the price action. I think investors should A, think about energy security, and B, focus still on that need for inflation protection in their portfolios.
Gagi, always good to catch up and see you. Gagi Chaudhuri there of BlackRock. That disconnect, we've talked about this countless times on this programme. In fact, I've talked to Jeff Curry of Carlyle in the past about the disconnect. It's a difference in the seat that you're sitting in. If you're in the equity seat at the moment, you are looking over an anticipatory asset class, seeking comfort from a backwardated futures curve, looking at the December price and saying, I can live with $70, $80 crude. If you're in the commodity market, you're looking at a physical market that has to clear demand and supply at spot. And that is very, very tight, to the point that we're seeing shortages in places like Asia. And that explains the difference with this sort of rosy outlook that come from the equity guys on this program and the doom and gloom that you see from the commodity analysts who are focused on the physical market at the moment. It's not to say that one is right and one is wrong. It's just a very big difference in perspective.
And your worldview. But for the commodity guys, it's not just what is happening right now. It's the future. What happens if it goes on a little bit longer? There's shut-ins. How long does it take to get production back? It's not just reopening the Strait of Hormuz. There are actually long-term potential implications because of what is going on right now.
And that is where the great attention lies at the moment, and the prospect for maybe higher than expected inflation. The risk-reward around the inflation story, Bramo, I think is the point you're trying to make this morning.
Well, to me, you can't have your cake and eat it too, although evidently you can, because that seems to be what's going on in markets today. But it seems like companies are saying the economy is better than you expected, and yet people are still saying, well, inflation expectations are going to remain controlled, even as the Fed potentially cuts rates once this year and once again next year. So where is the disconnect there in terms of the inflationary pressure that can take hold should the economy continue to outperform to the upside?
Futures on the S&P up by close to 0.1%. For an update on stories worldwide this morning, with your Bloomberg brief, Isabel Lee has more. Hey, Isabel.
Hi, John. At least 2 U.S.-sanctioned Iran-linked ships traveling through the Strait of Hormuz and into the Persian Gulf. The ships may have taken a new route from the UAE, passing between 2 Iranian islands as a U.S. blockade of the strait enters its 4th day. Treasury Secretary Scott Bessent says the U.S. will not renew the waivers on Russian and Iranian oil sanctions. The waivers were initially authorized to ease surging oil prices, pushed higher by the closure of the Strait of Hormuz. Global crude up more than 30% since the start of the war. And shares of BNY rising after beating on earnings. The bank posting profit for the first quarter, the top estimates, as client activity fueled revenue gains. The company's board authorizing a new share common repurchase program of $10 billion. That's your Bloomberg brief. John?
Isabel, thank you. Thank you for the update. Up next on the program, a diplomatic deadlock.
I saw some reporting, again, bad reporting this morning, that we had formally requested an extension of the ceasefire. That is not true at this moment. We feel good about the prospects of a deal, that we are continuing to see how these conversations go.
Turn on the sprinklers. Send down the lawnmowers. Bad reporting.
I mean, I felt bad for Tyler this morning. She had the lawnmower and the sprinklers all at once. Not even 7 a.m.
We'll catch up with Tyler Kendall in just a little bit. Up next, Rediker of International Capital Strategies, live from Washington this morning. Good morning. Equity futures right now just about positive by 0.1%, all-time highs at a close in yesterday's session, and looking to add some weight to the rally on the Nasdaq. 11 days of gains, the longest winning run since December 2019. Bramo, what have you got? Day 12? How long?
So day 12 would be since 2017.
Wow.
Past that, 14 days. That would take us back to 2014.
It's crazy. Some of the numbers out there. I was looking at semis. I was looking at the semi index, Philadelphia semi index, up by more than 20% this month. The biggest monthly gain since 2002. I checked it once. I had to check it twice. It's been explosive over the last 2 weeks.
And it explains the Kospi, it explains the Taiwan semiconductor. And the reason why the Taiwan stock index now is a greater market valuation than the UK one. So you can get a sense of how the tides have kind of shifted under the hood as a result of a very bespoke tech rally that has really changed the dynamic.
Does that tell you something about tech or about the UK
I knew
stock
you were going to
market?
say that,
Sort of
and I
one
think
or the
that
other.
it's a pull-push. You know, it's pushing on an open door.
OK, let's not beat up Europe too much this morning, OK?
Are you talking to me?
I get all these messages about being anti-European. I love Europe. I just haven't been big fans of European policy. There's a major difference between the two things. I'm a massive fan of Europe. Anyway, OK. Under surveillance this morning, a diplomatic deadlock.
I saw some reporting, again, bad reporting this morning, that we had formally requested an extension of the ceasefire. That is not true at this moment. We feel good about the prospects of a deal, and it's obviously in the best interest of Iran to meet the president's demands. I think he's made his red lines in these negotiations very clear to the other side, and so we are continuing to see how these conversations go.
So here's the latest this morning. The US and Iran considering a ceasefire extension, with key sticking points standing in the way of a longer-term peace deal. With the latest, Bloomberg's Tyler Kendall joins us for more. Hey, Tyler.
Hey, John. Good morning. Well, this White House maintains that they feel positive about the prospects of a potential deal, but still no confirmation on an extension or another round of in-person negotiations ahead of Tuesday's deadline. Though the White House press secretary Caroline Leavitt went on to allude to the fact that Pakistan would, in fact, hold the next round of in-person talks if and when they happen. Now, Bloomberg News is reporting that a 2-week pushback of that deadline could be on the table in a bid to give negotiators at the technical level more time to make progress on those big sticking points before senior officials meet face-to-face again, because at least publicly, the two sides still feel very far apart, including Iran's foreign minister saying yesterday that Iran's use of nuclear energy can never be revoked, testing the at least public red line from this White House about no nuclear enrichment. Then, of course, the issue of reopening the Strait of Hormuz, as data analyzed by Bloomberg News indicates that at least 2 Iranian tankers have appeared to make their way through the strait and into the Persian Gulf. CENTCOM gave an update last night saying that no ships have made it through the blockade and that at least 9 vessels obeyed U.S. instructions to turn around. We'll likely get an update on this part of the operation later this morning, within the hour, 8 a.m. Eastern. We're expecting Pentagon officials to brief. But, John, as you well know, it's not just the strait, it's not just the nuclear program. This White House was hoping that other issues would be put on the table, including Iran's support of proxy militia groups. The White House maintains that Israel's front against the Iranian-backed militant group Hezbollah is an entirely separate operation. But President Trump did announce last night that Israeli and Lebanese leaders would be meeting today in a bid to disarm that organization.
Tyler Kendall at the White House this morning. Tyler, thank you. Douglas Rediker of International Capital Strategies says the following: it's hard to see how the US does not emerge as a less powerful country as a result of this war and from other recent Trump policies. Doug joins us now for more. Doug, good morning. Good to see you.
Morning. Great to see you.
We've talked about all these different disconnects. The global audience for the IMF World Bank spring meetings, is there a divide, in your opinion, between what you hear from the US delegates and what we're hearing maybe internationally?
Yeah, I think that, first of all, there's a divide between policymakers and the markets. And then within the markets, there's a divide between the U.S. investor group, which generally sees things through a positive prism. To some degree, they're believing what they're hearing out of the White House. They're believing the rhetoric, the listen to what I say, don't watch what I do kind of mantra. And the rest of the world, and certainly the policymakers, are a little more skeptical, a little more, what I would say, realistic about what's going on, and a lot more wary.
So what do you make of financial markets buying the dip?
Well, look, I've long said buying the dip has been a great strategy as long as you've had two things. One, what is effectively a Fed or a central bank put, and another is the expectation that you're going to return to normal. And certainly the Fed put, central banks still remain a ballast as best as they can, though I would argue that President Trump's shots at Jay Powell and the independence of the Fed take sort of a bit of an edge off of that. But the idea that we're going to always return to normal is one that I would say right now is being called into some question. Is the current situation globally, Iran and more, Trump writ large, going to allow the system to return to normal, or is it going to be a new normal?
Isn't there a Trump put, though, given the fact that we have seen him on a jawbone the financial markets and the oil markets? Doesn't that just prove that there is a threshold he's unwilling to take?
So there's always this narrative, I'd call it overly simplistic, to say, well, Trump looks at the stock market, and therefore when the market corrects too much, he changes policy. That assumes that the policy damage that's done along the way is just a temporary thing and it goes away and we'll just ignore that and go back to normal. And so my premise is even a Trump correction that allows the markets to say, whew, I can exhale, I'm going to go back to normal. Is that always going to be the case? I mean, my big concern, I've got a lot of big concerns, but my big concern is if there were to be a global financial crisis, right? I'm not saying there's going to be, but, you can't rule it out. Is the world ready for a response function where the U.S. has affirmatively said, we're not taking the leadership role anymore? Is everybody ready for that? The U.S. is in charge, is the head of the G20 this year. Does anybody even remember the G20 exists? Right?
Can I ask you, though, do people seem more pessimistic right now than they did a year ago, or do they seem just the same or more optimistic?
A year ago was right around the time of Liberation Day.
Correct.
So that was mass panic about, oh, my God, he's serious. What does this mean? I think that the volatility born of the Trump administration is now something everybody expects. So more or less pessimistic. I think they were more shocked then and more pessimistic now. But I'm not sure pessimism or shock is a better or a worse characteristic to describe the mood of the meeting.
We had a test run. We had a global crisis in 2020. And President Trump was the president then. What's your assessment of how things worked out back then?
Well, I mean, the 2020 shock was certainly at a time when Trump was causing uncertainty in American leadership, but it was nowhere near where it is right now. I think Trump 1.0 people look back on, I mean, it's funny, there are a lot of Democrats who look back on the George W. Bush administration as the good old days now, right? Everybody goes to Dick Cheney's funeral and salutes him. That was not the case at the time. I think now there's a lot of revisionist history going on, and they look back at Trump 1.0 and go, well, it wasn't so bad.
Are you suggesting Democrats have figured out they need to stop pushing Republicans further to the right?
No, I don't think Democrats have figured out.
Okay, just throwing that out there.
Right. I think in general, though, I think that the damage to U.S. leadership done under the Trump administration 1.0 is qualitatively different than what's happened now. Both because Trump has affirmatively said, I'm walking away from NATO, I'm walking away from alliances, I'm walking away from everything. And at the time, his aversion to the WTO was big news.
Yeah, this is different.
This is different.
This is different. Doug, it's good to see you. Thanks for being here.
Thanks for having me.
Thank you, sir. Doug Rediker there of International Capital Strategies. Up next on the programme, a must-watch conversation with the Barclays CEO, CS Venkatakrishnan. Three-day winning run on the S&P 500, a record winning run. A record on the S&P 500 for the first time since late January, and a 10% move plus off the lows of the last few weeks. On the S&P, we advance again by close to 0.1% on the Nasdaq, an 11-day winning run, the longest daily winning stretch going back to December 2019. On the Russell this morning, up by 1/10. In the bond market at the moment, later on, 60 minutes from now, jobless claims, another read on the labour market in America, yields on 10s at 426.57. Pre-war, that was the upper end of the trading range for a 10-year year-to-date. So we're back to those kind of levels. At the front end of the curve, still anchored by a Federal Reserve that, Lisa, is not set to go anywhere anytime soon.
Yeah, even if Kevin Warsh gets his position as Fed chair, I want to just note that Treasury Secretary Scott Bessent yesterday said that ultimately he would understand if the Fed needs to wait on rate cuts, given the fact that there could be potentially inflationary pressures. It's almost, an allowance, a free pass. You can go a little bit longer without trying to push on rate cuts, given the fact that inflation keeps running above
Such an odd situation with the Federal Reserve. We've been in Washington for the best part of 24 hours, and everyone I meet with have asked the same question. Why isn't the president taking the off-ramp here? He was offered an off-ramp to allow Chairman Powell to head to the exit, get his map at the top of the Federal Reserve Board. Overwhelming support in the Senate to get him confirmed. Senator Tom Tillis of North Carolina has already made that point. If the DOJ investigation goes away, he wants to confirm Kevin Warsh, and yet they're not taking the off-ramp on this situation at all.
The president's doubling down on what he thinks is gross misconduct because of the renovations. I haven't been able to get anyone to give me an exact definition or explanation of why he really does not want to take that off ramp, but he'd rather double down and have that fight. But it might mean that it's going to be a lot longer to get his pick at the top of the Fed.
And Chairman Powell might be sticking around beyond May. 2 hours away from the opening bell. Let's get you some single names, some morning movers. Danny Berger has more. Hey, Danny.
Hey, John. Looking at the ADRs of TSMC this morning, now flipping into negative territory, down 1.8%. Despite the fact they had solid earnings that beat, they raised revenue guidance for 30%, said that they still have supply constraints going into 2027, but the stock is one that we know had been doing well, so some of that already priced in. Meanwhile, PepsiCo also reporting earnings, and they also beat on both revenue and earnings. They cut prices by about 15%. They were pushed also by activist investor Elliott to do so. So that seemingly helping them with getting sales done. They also talked about overhauling their Gatorade brand for more health-conscious consumers, lower sugar, more hydration. That's what the market wants to hear. Apparently shares up 1.2%. I'd also be remiss if I didn't bring up Allbirds, now Newbird, or whatever the AI company is called now. I mean, this thing was crazy yesterday, surging more than 580%. Saying that they're raising $50 million in a convertible bond sale in order to become an AI company. William Blair points out the wildness of this, that usually these kinds of companies need billions of dollars to undertake this mission. It's given kind of 2017. T Company says that they're a blockchain company to get a bunch of retail dollars flowing in. Either way, we're undoing some of it today, down 22%. But again, John, it was up nearly 600% yesterday.
That's exactly what I thought. Danny, thank you. I was thinking of the same thing from back in 2017, 2018 and all that craziness. My mother-in-law was the one person that messaged me yesterday asking if they still make shoes. So
ugly shoes.
That's like their target audience
right
like now,
shoes.
right? Yeah, I don't think you're alone. That was the one person that raised that question. I didn't see anyone else ask it. And maybe that was the problem all along for the company. On our radar this morning, Alphabet eyeing a massive payday as SpaceX prepares to go public. An early investment in Elon Musk's company, positioning the tech giant for a potential $100 billion windfall at a $2 trillion IPO valuation. Just phenomenal. Elsewhere, US and Iran are weighing a ceasefire extension ahead of next week's deadline. Mediators working through the main sticking points, including the reopening of the Strait of Hormuz and the future of Iran's nuclear program. And finally, the Treasury Secretary, Scott Bessent, saying the US will not extend the general licenses on Russian and Iranian crude.
We will not be renewing the general license on Russian oil, and we will not be renewing the general license on Iranian oil. Because again, that was oil that was on the water prior to March 11th. Right. So all that has been used.
The waivers were initially authorized to ease crude prices. AMH pushed higher, of course, by the closure in Hormuz.
So within these 3-4 weeks, we've seen the administration take a very different approach. First, it was a lot of panic, it felt like, from the White House about making sure that every single country that needed access to products and oil was getting it. So they had these general licenses for Russia and Iranian oil at sea. What is interesting, though, and the Treasury Secretary and OFAC will never actually come out and say it. You have to get other countries to leak to you. They could do individual waivers for individual countries. And what I've been hearing is several Asian countries, especially India, has been lobbying this administration. So we need to be asking, will you do direct country waivers for certain products? AKA, can India continue to buy, say, Russian crude? It wouldn't be in a general license, but it would be an individual country waiver. I imagine that is happening, but they would never confirm it.
The fiscal markets are still super tight and the warnings are still coming from the IMF. We caught up with the IMF Managing Director, Kristalina Georgieva, just yesterday. She was warning that the war's energy shock will take time to unwind.
If the conflict persists
and oil prices stay high for an extended period, we must brace for tough times ahead. March was a tough month, but April is likely to be even tougher.
March was a tough month for markets. April has been absolutely fantastic. Let's talk about that disconnect now with the Barclays CEO, CS Venkatakrishnan. Venkat, it's good to see you, sir. Thanks for being here.
Always happy to be here. Thanks for having me in Washington.
It's an uneasy calm, an uncomfortable calm. These warnings from the IMF, and then I look at the screens. I look at the Bloomberg terminal, all-time highs on the S&P, on the Nasdaq. How do you feel personally about that disconnect at the moment?
Well, I think that there is a short-term look-through in the markets, especially the equity markets, as to the prospects of both the war ending quickly and exuberant spirits and investments and IPO calendar and deals. That's what keeps the stock market going. But in the background, humming slowly, are the long-term consequences potentially of what's going on in the Middle East. And, you know, both the inflationary risks it can create as well as the growth risks on the downside, which is what will give central banks, pause as to how they deal with this situation. I think some of the liquidity concerns we're seeing in credit, and not everybody in AI is going to be a winner. These are the things that are humming in the background.
Well, let's pick out a few of these themes. The deal flow, the IPOs we could see this year. We are potentially going to see not one, not two, but maybe three of the biggest IPOs we've ever seen in the history of financial markets in the US. Do you see the situation in the Middle East in any way, shape or form potentially upending the deal flow that we could see, the IPOs, through the year ahead?
Not in a structural sense, because it could affect timing. Do you go this week or do you go a month later? But the companies you're talking about, let's just take one of them, SpaceX. These are remarkable companies that have been built offering important real products to the global economy. And the capital that they will get from an IPO is meaningful.
How real is this progress? This is something I've really had to wrestle with over the last 6 months or so. When the Anthropic CEO comes out every other week and makes some dire warning about the future for white-collar work, and now we are all hearing about Mythos and banks needing to work with it because it could potentially be incredibly dangerous for the financial system. What's your understanding of what's on offer right now? Is it part of the IPO roadshow, just a marketing effort to boost valuations, or is it the real deal?
Yeah. So first of all, on the first part of your question about the impact on workforce, I think it's really important for the large corporate employers like us to be very responsible in the way in which we use AI, both in terms of it's going to offer deeply personalized services, but they need to be using proper data and offering proper products to customers. And then the second thing is it's not just about efficiency, it's also about innovation. And we need to reskill our workers to make sure that they offer better products and better service going forward. That's one side. The second thing is the pace of change with AI and the capabilities that it's showing are really quite remarkable. So we've got to take every conversation seriously, including the Mythos one. And we have to assess what the impact of it is, and we have to assess how we can protect ourselves. So we have to take it seriously.
At this point, can you give a return on investment tied to the deployment of artificial intelligence throughout your ranks? Or is that going to be a sticking point with ongoing investment at the pace that we have seen in some of the big tech companies?
It's a very important question, Lisa. And I think from the corporate side, I think, A, we have to adopt it. B, we have to invest in the infrastructure that allows us to adopt it at scale. And C, and this is the hardest part, we have to generate true end-to-end use cases that are high value, that take an old workflow and make it into a new workflow. That's going to be the hardest part. I believe value will come. I believe this is a great and deep technology. And we're going to do it from the point of what is needed and effective. But I think trying to put an ROI on any individual project is a bit of a fool's errand.
Which is part of the reason why people are derating some of the big tech names that are investing so heavily, because they can't prove that. A lot of people say the reason why markets are doing so well is because of how much liquidity there is in the market. And one big source of that liquidity has been money from the Middle East. Yeah. How much is that going to pose a problem going forward, given the fact that this area needs to rebuild and invest in itself in a different kind of way going forward?
Yeah, and I think the Middle East and Middle Eastern countries are obviously going to have a reconstruction bill at the end of this. But they're also going to have to rethink their defense systems. right, for decades in the future. And so you would imagine that some of the investment would be inward. But by the way, that's been happening for many years in the Middle East as they've been looking to de-risk themselves from oil dependence. Now, oil prices have gone up recently, but they're looking to broaden and diversify their economies. The UAE has done it. Saudi Arabia is looking to do it. So there has been more inward investment in the past few years than there used to be.
But now, do they offer a safe place for businesses to actually go there and offer this diversification thereafter?
Well, I think the attractiveness of the UAE, the strength of the Saudi economy, will continue to be strong. And I think investors will appraise those risks that are happening now, but I think the sooner this war comes to an end, the easier that statement is to make.
Are all your plans that you had before the war for the kingdom and the Gulf writ large still in place? Like, are you still looking for that private banking license in the kingdom?
Yes, we absolutely are looking for a general banking license in the kingdom, and we're opening our regional headquarters there later this year. Those plans are in place, and we remain as committed as ever to the Middle East.
Can we finish on Europe and how things have changed? I've often been accused of being anti-European. I certainly don't feel that way. I feel very pro-European. I have not been very pro-European policy over the last decade. There's clear and evident mistakes that have been made by leaders across the continent. Do you see a change taking place on the continent and in the UK, a change in policy that would benefit the economy?
Yeah. Well, I certainly see it in the UK, about which I can speak a little more knowingly. I think the UK economy, this morning they had a very strong GDP print, and if March is flat, it's going to be a 0.7% quarter, the first quarter, which is quite strong, right, and on the better side of things. Gilts are now in the middle of a range of trading, but the UK continues to be business-friendly, invest in its economy in both the financial sector, technology, and biotech, is looking to diversify its energy dependence. I mean, it's going back to some more usage of oil and natural gas from the North Sea. And I think the UK continues to be an open economy trading with the rest of the world. Europe, on the other hand, has more to do in creating a more perfect union, if we can use the Washington term, in terms of certainly its capital markets, its banking system, and trade. So I think more to do in Europe. I'm pretty optimistic on the UK.
Venkat, appreciate your time, sir. Thanks for making time for us. Thank you. Thank you for being here. I know you're in a quiet period, so we can't talk about the financial results, but best of luck, of course, for the quarter. Thank you, sir. The Barclays CEO, CS Venkatakrishnan. On the Middle East as a source of capital, important question, Bramo, that you brought up. Will Liv Gulf be the first victim of that source of capital and the financial support that has come from the kingdom over the last several years?
Well, that's what the reporting is, that this is literally on a lifeline. So basically, without the Saudis, Liv Gulf basically doesn't exist anymore. The timing is going to be interesting. I looked at the Liv Golf schedule. I would never normally do this, but I checked it out. And in a few weeks' time, there is a tournament right here at Trump National in Washington, D.C. Would you pull the funding before you're about to host a tournament at the president's golf course?
It's a good point. I've not heard that point being made in the last 24 hours. Yeah. Plenty of speculation about the collapse of this golf league. I, for one, don't have skin in the game, of course, but I will say this. I want the best players all playing on the same tour. And the fact that the likes of Bryson DeChambeau has been playing somewhere else and hasn't been playing on the tour, I think, has been a loss for the golf world over the last several years.
So I didn't understand anything you just said, but it's clear to see you want the Saudi.
You got to check.
We were smiling, so I thought that you were coming along for the ride.
I know exactly what you're talking about. I think that you're right. I think a lot of people
because of the memes. I understand exactly what's been going on now between PGA and Liv, because the memes on FinTwit are fantastic.
Okay, let's move on. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Isabel Lee has more. Hey, Isabel.
Hey, John. Europe has 6 or so weeks left of jet fuel. That's according to the head of International Energy Agency, Fatih Birol, telling the AP that flight cancellations could escalate soon if oil supplies remain blocked. He went on to say that the front line is Asian countries, with Europe and the Americas to follow. Blue Owl posting its biggest 2-day gain since November 2022. This comes after PIMCO reportedly purchased all $400 million of bonds issued by a Blue Owl private credit fund on Monday. Sources telling us here at Bloomberg that the bonds were relatively sold at a cheap valuation, and the move represents a vote of confidence for the private credit industry. And the Saudi-backed Liv Golf League could be on the verge of a major crisis. The Wall Street Journal reporting that Saudi Arabia's sovereign wealth fund may pull almost all the funding from the league that drew star golfers away from the PGA Tour when it launched in 2022. For now, LIB's operations are set to continue as scheduled. And that's your Bloomberg Brief. John?
Isabel, thank you. Thank you for the update. Up next on the program, confirming Fed Chair Kevin Warsh.
I am very optimistic that Kevin Warsh will be the chair of the Fed on time. Let's get to the hearings and see where we are then.
Up next, we'll catch up with the former New York Fed President, Bill Dudley, live from Washington, D.C. You're watching Bloomberg TV. Stocks doing okay, better than okay over the last few weeks, that's for sure. 11-day winning run on the Nasdaq, on the S&P 500, a record-breaking run, a move of more than 10% off the recent, and I stress recent, equity market low. Equity futures on the S&P up 0.1% on the Nasdaq, up by 0.2. Under surveillance this morning, confirming Fed Chair Kevin Warsh.
I am confident that the process that we've laid out in terms of Kevin Warsh becoming the next Fed chair. He's going to have the hearing on the 21st of this month. He's a great candidate. We know that the Republicans on the Senate Banking Committee are aligned in that, and I am very optimistic that Kevin Warsh will be the chair of the Fed on time. Let's get to the hearings and see where we are then.
So here's the latest this morning. The Republican Senator Tom Tillis telling CNN he's still planning to block Kevin Warsh's nomination. The ongoing DOJ probe into Fed Chair Jay Powell clouding the confirmation process. The former New York Fed President, Bill Dudley, joins us now for more. Bill, welcome. And this is a difficult question to answer, so forgive me. We go straight to the realm of speculation. But if you had to guess what the FOMC looks like in the month of June, what would you guess it's going to look like?
I assume that somebody's going to blink. Either the Trump administration is going to withdraw their investigation of the renovation of the headquarters building, or Tom Tillis is going to decide that he will align himself with the Republican majority in the Senate Banking Committee and vote to affirm Powell. But we're not sure. And if they don't, if Tillis doesn't withdraw his objection, if the Trump administration doesn't stop the probe, then it's very likely that Powell will stay on as the acting chair. At that point, Trump has threatened to fire Powell as the acting chair, and it's not clear legally whether he has the authority to do so. So it's a bit of a mess. It obviously makes the job for Kevin Warsh also more difficult, not just because of delaying, potentially his taking over from Powell, but also he's going to be viewed with quite a bit of skepticism, I think, by the rest of the committee. Is he there to do what's appropriate for the Fed in terms of the conduct of monetary policy, or is he there to do the president's bidding?
So, Bill, these are important questions, and we all take seriously the threat to central bank independence. But I think we also take comfort from how well anchored inflation expectations have been throughout all of this. Do you see anything on the horizon that might upset some of that?
Well, inflation's expectations are anchored in part because people think the Fed will do the right thing. So it's not independent of the Fed's behavior. So I think that people would be very upset, I think, if Powell is somehow fired and it goes into the courts and it has to be adjudicated. Kevin Warsh, I think, is going to have to win the hearts and minds of the rest of the Federal Open Market Committee. I think it's very unlikely that the Fed's going to cut rates in June. I think with headline inflation going to be close to 4% on a year-over-year basis, then I think the sentiment is going to be to watch and wait, and in part to ensure that inflation expectations do stay well anchored.
We saw yesterday Treasury Secretary Scott Bessent came out and took the heat off of Kevin Warsh should he become Fed chair by May 15th, as is expected, or at least scheduled, saying that he would understand if the Fed needs to wait on rate cuts, even if he ultimately saw large cuts beyond that. How do you see a Treasury-Fed accord working together to shrink the balance sheet and reshape the way that the Fed controls rates at the front end and the shape of the curve?
I don't think they're going to change how they execute monetary policy. I think they're going to remain in a regime where reserves are above the supply of reserves is above the demand for reserves. What I think they're going to do is make some changes structurally that reduce the demand for reserves. And if the demand for reserves can come down, then the supply of reserves can come down and the balance sheet can shrink. But I think what's probably being exaggerated a little bit is how much restraint that will cause. If you shrink the balance sheet by, say, $1 trillion, which is probably the order of magnitude that we're talking about, it's going to exert very little real restraint on the economy. So the idea that balance sheet reduction can lead to dramatic declines in short-term rates, I just don't think that's credible.
I remember back in 2021, you came on the show and you said that 10-year yields could be at 5%. You could see Fed funds rates at 5%, given the inflation building in the system. Right now, do you think that people are overly sanguine with just how much inflation is building in the system as a result of the commodity shock stemming from the Middle East?
Well, I think that it's correct for the Fed to think of this as a temporary shock, that energy prices are probably going to go back down in the fullness of time. But I think they're constrained for two reasons. Number one, we've been missing the inflation target to the upside for 5 years in a row. So every month and year you stretch that out, there's more risk to inflation expectations. And number two, the Fed's independence is under attack. If the Fed's independence was not under attack, the risk to inflation expectations would be significantly lower.
Bill, it's good to see you. Thanks for your stern conversation there. Bill Dudley there, the former New York Fed president, some pretty pointed opinions on the future of this central bank and the threats to independence that we've seen building from the administration this year.
Right, but as you've pointed out, it's not actually showing up in financial markets. Financial markets don't really feel like there is a threat to independence. On the other side of that, is Jay Powell also himself threatening the independence if he stays on as a governor until 2028?
Dependency issue. Someone messaged me that yesterday, I forget who, but a dependency issue. Is the chairman creating a dependency issue where we associate central bank independence with one man on one committee, and how problematic might that be once the chairman does step away?
Well, it would be problematic because it's a deliberative body. It's a deliberative body, which is why people don't think even if Kevin Warsh was tapped to lower interest rates, he's going to be able to come in and do it right away, immediately.
Right now, I'm just watching this, and I'm watching this play out in Polymarket. And right now, you have the lowest chance ever of Kevin Warsh getting confirmed by May 15th, which is the time when he should step in. And right now, you have about, I believe, a 31% chance that Fed Chair Jay Powell will not be on the Board of Governors by May 30th. So it's definitely setting up for, the rich housewives of, Washington, D.C.
Is that what we're calling it?
Or Bachelor, or whatever you want to call it. But it definitely feels like, it's sort of one drum over here and markets are over here saying, tell me when it's over. At what point do you get sort of a confluence of those types of
ABC should buy that. No Bachelorette this year.
I think that
they should buy that.
Washington, D.C. drama.
Yeah.
That is actually a very good idea.
We haven't talked about that, have we? Huge news for networks in this country.
So there's no roses. We're not going to.
There you go.
No roses.
We should do it at the Federal Reserve.
That would be fun.
That would be a great way to correct that. Coming up on the programme, Franklin Templeton CEO, Jenny Johnson, Michael Morris of Guggenheim, Jonathan Pingle of UBS, Mahajan of Edward Jones. From Washington, D.C., the third hour of Bloomberg Surveillance, up next.
U.S. exceptionalism is not going away.
There is an awful amount of good news already priced in.
Investors have been very cautious about missing this.
The earnings power are there. Estimates for cyclical earnings are most likely too high.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from the nation's capital this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P, positive by 0.1%, adding to a three-day winning streak on the S&P, adding to a record-breaking run, a move of more than 10% off the equity market lows of only the end of March. On the Nasdaq 100, higher over the past 11 sessions. The previous 11 sessions driving the Nasdaq 100 to a new record high. Make it day 12, Bramo, and you've got a winning run we haven't seen for quite a while.
Yeah, if you make it 12, we're going back to 2017. 14, we're going back to 2014. And people talk about how it's unprecedented, the violence of this move up in terms of how big this rally has been to new record highs since a 5 to 10% drawdown. I mean, that is the fastest kind of recovery that we've ever seen. So is it real? Is it a disconnect from reality? We've been talking about that all this morning. Or does this highlight just how much energy there was under the surface that perhaps wasn't being appreciated earlier?
Renewed enthusiasm for the tech trade, particularly here in the United States, also in South Korea. The Kospi has had a massive run again for this month, encouraged by the outlooks from ASML, but more so from Taiwan Semi overnight, lifting their outlook, supporting the tech trade. Is it renewed confidence in that, or just comfort with the situation in the Middle East? I would have to say it's difficult to be comfortable with the situation in the Middle East. The fragile ceasefire that might be extended another 2 weeks, that would take you into May. That would mean this has gone on for more than 2 months. And a key question would be, if we extend the ceasefire, are we reopening the Strait of Hormuz or not? Because at the moment, we've got a ceasefire, but we also have a blockade.
Yes, we have a blockade, and at the moment, you are not seeing the normal flows of energy. And I would even say might have this extension of a ceasefire. There has been reporting that they are engaging potentially to have this extension, but Caroline Leavitt was pretty direct yesterday. She said all the reporting was false, and there hasn't been a formal request from the United States to extend the ceasefire. So we still have to wait whether or not this is going to be extended after April 22nd. And the real question is, if there's an extension of the ceasefire, does this just mean what we're seeing right now, which is we're not seeing a lot of facilities hit and a lot of drone strikes, et cetera, or we actually see the Strait of Hormuz opened? Even if it becomes opened, it's not going to be the level of volume you were used to.
What I'm struck by is the number of people who are saying even if the Strait of Hormuz is not reopened in full, they still will see this rally continuing because just less bad news is enough. And I think that that's telling. You could say, OK, that's complacent and that's just simply the ignorance of markets. I'm going to just stick up for markets here for a hot second, because ultimately the world has changed and certain pockets are not as dependent on some of the policies and some of the products coming out of the Middle East, including the U.S. So people are saying if I can game out what the risks are, I can invest once again because there's a lot of potential upside.
The scariest thing that's happened in the last month, do you want to know what it is? You know exactly what I'm going to say.
Yeah, but I was talking as a representative of the markets, defending markets and being positive.
I'm doom and gloom. I'm doom and gloom. The world order has changed.
That's happened in the last month.
Well, concerning we never go back.
I'm
when
contrarian.
Did you become bullish?
I'm not.
When did this happen?
You know,
this is going to freak a lot of people out.
I'm just not seeing the same kind of pessimism coming through in the earnings picture and the adapting and the adjusting. I feel like Tom Keene has just been incredible. I don't know what happened.
Now
I think I'm going to leave. I think I'm going to leave right now. I think I'm done.
I was constructive on the outlook, and now I'm questioning everything that I believe.
All right, that means your sell everything moment just happened.
Coming up, Franklin Templeton CEO Jenny Johnson on a record-breaking rally. We'll speak to Michael Morris of Guggenheim, looking ahead to Netflix earnings, and Jonathan Pingle of UBS breaking down the latest jobs data. We begin this out with stocks rising following a milestone session that saw the S&P 500 close above 7K and driving another record high. Franklin Templeton, the CEO. Jenny Johnson joins us now for more. Jenny, good morning and good to see you here in Washington.
Good morning. Great to be here.
That disconnect, I'm sure you've pondered the same disconnect a million times over the last month or so. Does it feel uncomfortable to you? Do you take Lisa's view of the world?
Well, first of all, I mean, sadly on this, there are winners and losers, right? You know, if you're an oil exporter, this is actually pretty good for you, right? And we're talking about the S&P 500, so You're talking about U.S., right? We are now energy independent, so that's helpful. We've got a really strong consumer, and I can share some data that I think is important. And I think that the AI, again, it hasn't yet, in the productivity gains that we've seen, none of that is from AI. That is from tech that was introduced 20 years ago that takes time to get in the system. And so you're going to continue to see, I think, companies be able to increase their margins because of and if they have to increase their price because of the inputs, and we know that with the supply chain adjustments, they might be able to actually absorb it because of the productivity gains they get with AI.
So 2 points there, one on the consumer and one on tech. So let's split them up. Let's start with the consumer. What are you seeing in the data?
So it's interesting. So we have about 280 billion private markets. So we actually get, our secondaries gets information on 55,000 private companies. And so they're getting updates. Now, there's a little bit of a lag on that. But our real estate and our private credit, they would tell you they're middle markets. That kind of tells you I think the real core of the economy. They see companies, they don't see any real increases in delinquency, so they're not seeing stress there. And they're actually seeing them outperform their projections, right? So that tells you that it's pretty strong. Our real estate, the only place I'd see a little bit of weakness is that in some markets, you're seeing new leases drop down a little bit, but others you're seeing it strong. So the data still feels like the economy is very strong. The consumer, I was at a session with a bunch of CEOs yesterday, and one of the retail firms said gosh, I have a disconnect between what the Michigan consumer sentiment is and what we're seeing.
Part of the reason why might be something that DataTrek pointed out this morning in a note, which is this data compiler and data firm saying that U.S. corporate profits have been growing faster than the domestic economy since the year 2000, and they've been outpacing American workers' benefits from this economy for that same period of time, and that gap has never been wider. I mean, at what point are we seeing a dispersion between corporate America and the S&P 500 doing fantastically, even though the economy might not be keeping pace, at least not in the eyes of a lot of different individuals?
Well, I think this is the challenge. Anytime you get new technologies that get introduced, and I always describe, there's a great picture of Wall Street around the 1900s, and there is one car and all horse and carriages. 10 years later, it's all horse and carriage. I mean, it's all cars and one horse and carriage. And I'm pretty sure the guys that were maintaining the horses didn't suddenly become mechanics, right? So there's a period of time that you have to adjust, and we're going to have to go through that. But I'm an optimist, and I look at in history, every time there's a big technological advance, there is this prediction about the American or the worker is not going to be able to adjust, and they do adjust. And you have to remember with AI, suddenly the skill sets that you had to learn, if you couldn't afford a really expensive education, you were left out. You couldn't be a programmer. Now, honestly, the benefit goes to those who are creative. I think it's really important that companies, not only for their own benefit, but also for America, that we teach people how to leverage these tools.
So just to go back to that analogy, it's fine if there's one car and lots of horses and buggies, if one guy driving the car feels pretty happy and just wants to stay in his lane. It's another thing if that car just wants to go run over everything else, which is sort of the fear of some of the technology, right? And this is sort of the fear.
This is what we like to hear.
I'm feeling normal again.
Well, no, I'll explain my bullishness about other stuff in a second. But I'm just curious, going forward, what is the fear that the disruptors and the sort of nefarious element tied to AI and mythos and some of these cybersecurity issues could outpace and disrupt some of the progress?
It is for sure a risk. Let's talk about mythos, because I know everybody's kind of worried about it.
Nobody wants to talk about it, so please talk about it.
So, here's why I ran the technology department. Before you ever introduced new software into your environment, you do what's called an ethical hack. You hire people to say, go in and try to break into my system. The challenge with that is that's a one-time event. So once it's in, you sort of assume that it's okay. And believe me, I think you get an update every week from Microsoft saying, oh, we found a vulnerability. Please, load in the latest fix. Imagine in an environment being able to run an agent full time that is constantly trying to find your vulnerabilities. That is actually going to be a benefit. Now, you could say, well, you got to race faster than the bad guys doing it. But if it's always in your environment, and by the way, it's in your environment. So the first thing they have to do is get through all of the layers. And the way you run technology security is in layers. Somebody might get through the first fence. You're hoping they don't get through the second fence before they get to something that's important. And so if you can run this all the time, I actually think that's going to be an advantage to businesses. It's just scary when you're first, sort of thinking about it. And the other thing is, once these things get out there, they do get out there. It's hard to contain the technology programming that's, so the bad guys will get it eventually. You hope that we can get this rolled out to some of the businesses. They start to build these agents. They work with, Anthropic to build them. And then I think that they'll be less vulnerable.
Isn't the concern is right now that some of the adversaries are embedded in it or could be embedded in it right now at the starting steps?
But that's always the risk, right? I mean, I think companies have seen where, you have an employee that's hired. If you don't do enough check around it, we had a situation where an employee was hired as a contractor, and our security group found that they were trying to send data out, right? I mean, that happens all the time. You always say you're most vulnerable is potentially your internal employees. You got to make sure they're trained, and you have to build a system of layered security where you're analyzing patterns, and AI gets better at that. You're analyzing patterns all the time to say, is something changed? And that will tell you, hey, there's an alert, you need to look at something. And so the key is you've got your core data here. You may not catch them on the outside. You may not catch them here, but you're going to catch them before they get to it. And that's the key to any kind of a security environment. That's also why we don't like to share our architecture, because it kind of tells people how to get along. So anytime the government's like, oh, you need to show all your security, that's a disaster. You don't want to do that. You need to keep that very private.
Jenny, there is an industry dedicated to criticizing U.S. policy, but much of the innovation that we're talking about right now is coming out of the United States. Dare I say, is this the return of US exceptionalism with these all-time highs in this equity market, or is that too premature?
Look, I think we haven't lost U.S. exceptionalism. We are incredible innovation. And I don't know that any of us can fully understand why the ecosystem of Silicon Valley hasn't been replicated throughout the United States. Like, there's something special about that. Austin's got a bit, Boston's got a bit, but still Silicon Valley continues to have it. And honestly, in China, Shenzhen and Hangzhou, both of those are pretty exceptional. But for some reason, it's about universities, it's about capital, it's about creativity. It creates this ecosystem. So I think that, the U.S. has never lost their exceptionalism.
At times, despite policymakers' best efforts as well, particularly in California, right?
Well, that's true. And actually, in fairness, Silicon Valley has gone through its ups and downs. Although I recently saw that office space was going at a new record high. And when you take a look at some of the housing, talk about coming back. So, I mean, talk about the innovation engine there.
Real turnaround. Jenny, this was fun. It's good to see you. It always is. Thank you. Jenny Johnson there, the Franklin Templeton CEO. There has been a briefing taking place at the Pentagon. We've heard from the Defense Secretary, Pete Hegseth. Let's cross over to Tyler Kendall, who's been tracking that from outside of the White House. Hey, Tyler.
Hey, John. Well, the briefing is ongoing, but Secretary Pete Hegseth started his remarks by renewing a threat that the U.S. is, quote, locked and loaded on dual-use infrastructure, referring to the prior option that the U.S. could go after power plants and bridges that they argue serve military purposes. However, Hegseth says that at the moment, the U.S. military doesn't want to pull that option and instead pursuing this blockade in the Strait of Hormuz, which he called the, quote, polite option, also adding that the U.S. is prepared to maintain it for as long as it takes. He also noted those renewed economic pressure points that the U.S. Treasury Department has been rolling out, including the Treasury Secretary yesterday, saying that the U.S. is now working again with Gulf countries to freeze additional assets of Iranian leadership in their banking systems. John, at this point, the headlines are still coming in, but Hegseth also did maintain that the U.S.'s public red line is that Iran cannot have a nuclear weapon amid questions on how these negotiations are going to go, with the sides publicly still very far apart.
We'll keep tracking that briefing. Tyler, thank you. Appreciate the update. Tyler Kendall there from outside of the White House. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Isabel Lee has more. Hey, Isabel.
Hi, John. Alphabet's early investment in Elon Musk's SpaceX is positioning the company for a massive windfall. New filings show Google owned just over 6% of the rocket company at the end of last year. At a targeted $2 trillion IPO valuation, that stake would top $100 billion. Charles Schwab shares are falling after reporting first quarter earnings. Total new assets jumped nearly 6% from a year ago and topped estimates. The brokerage had faced headwinds in the quarter on fears over AI disruption. And talks are scheduled today between Israel and Lebanon. According to an Israeli official, the country's prime minister and the president of Lebanon will speak following ambassador-level talks in the U.S. earlier this week. Those were the first direct discussions between the two countries in more than 30 years. That's your Bloomberg brief. John?
Isabel, thank you. More from Isabel in about 30 minutes' time. Up next on the programme, the Morning Calls, plus Michael Morris of Guggenheim looking ahead to Netflix results from Washington, D.C. this morning. Good morning.
Does the Iran war really matter that much to the global earnings outlook, particularly to the earnings outlook of the S&P? I don't think what we've seen in the last 11 trading sessions is the irrational reaction. I think actually what was irrational was the really sort of the 20% derating and compression that we've seen in S&P multiples at the beginning of the war.
I think it's still early, but I give so much credit to the equity market bulls that just stuck with it, stayed overweight. Max Kettner of HSBC being one of them. I think of Barclays and Venu over there, who lifted his outlook, his price target on the S&P 500 in the middle of a war, when crude was north of $100 a barrel and people were genuinely freaking out. He was just looking at earnings expectations getting better and not worse. And as far as he was concerned, breaking down the numbers and saying that's a reason to be bullish here, not bearish. That's what's kept this market pretty anchored. It's what's driven gains off the low of more than 10% on the S&P 500. It's why we sit here this morning at all-time highs. and up at least for another 1/10 on the S&P.
Yeah, so here, just to clarify, I'm not wholesale bullish, and I'm not being completely ignorant of everything that's going on. It's just that with supply shock after supply shock, the companies that have been successful and gotten bigger have management teams that are really smart. And you see this in a consistent way. It doesn't necessarily reflect underlying strength necessarily, even of the U.S. economy, because you're seeing that divide get wider. But what it is highlighting is the ability and the resilience to innovate among some companies. So it doesn't necessarily represent the underlying economy. In fact, that gap, again, seems to be growing.
It's that line from Savita, once again, never underestimate the resilience of corporate America. That's the price action. Let's get you some morning calls. First up, Bank of America raising its price target on Morgan Stanley, saying management's messaging on resilience should boost investor confidence. Your second call from Raymond James upgrading Okta to outperform, saying, quote, a forward waterfall should lead to growth upside. And finally, JP Morgan lowering its price target on Keurig Dr. Pepper, saying the stock remains in purgatory. Let's turn to earnings. Netflix reporting first quarter results after the closing bell. Investors looking for insight into the future of streaming. Geetha Raghunathan of Bloomberg Intelligence joins us now for more. Geetha, welcome back. What are you expecting a little bit later?
Yeah, thank you, John. So the big story, obviously, is that they've dropped the Warner Brothers Discovery bid, and it's really, business as usual for Netflix. So they're no longer reporting subscriber numbers. So the key metrics that we watch for and the street is looking for is really revenue growth. They're guiding to about 15% revenue growth for the first quarter, which we think they'll easily achieve. Remember, they just raised prices in the U.S., so that should set them up for a good path to revenue growth for the rest of the year as well. They've guided to about 12 to 14%, but we think that they can up guidance for the full year. Again, that really just goes back to prove the underlying, fundamentals and the strength in those fundamentals. And then, of course, John, the other big number that we look for is operating margin. And we think there is a chance that they raise guidance for operating margin as well as free cash flow for this year as well.
Geetha, always appreciate your input and looking forward to you breaking down the results over the next 24 hours. Geetha Raghunathan there of Bloomberg Intelligence. Michael Morris of Guggenheim remaining bullish on the stock, writing, we maintain our buy rating and view the first quarter call as critical for understanding management's strategic priorities. Michael joins us now for more. Michael, welcome back. Let's get your input on things. How distracted has this management team been by the pursuit of another company?
Oh, thanks for having me this morning. I think the answer to that question is that they have not been terribly distracted. Okay, clearly the initiative to pursue Warner Brothers Discovery was a big deal, and senior management was very focused on that. But the company was consistent throughout the process, and on the conclusion of the process, that this was one of their initiatives. It was an opportunity. It was a nice to have, not a need to have. And that the balance of the business was really running, as I think you said, it business as usual and focused on the areas that they wanted to grow. And you saw some of that come through in the first quarter with some new content initiatives and other items, the pricing action that were really independent of the bid for Warner Brothers.
I think for some investors, Michael, they were happy with the outcome of that pursuit. Happy because this stock is up by, I think, 9% in just the last 6 days and had a rally as soon as that news broke as well. Michael, I'm always interested in pricing power in general for the broader consumer and price tolerance. But for this company specifically, how much pricing power, Michael, does it actually have?
I think that there's still runway for pricing, but the story does get a bit more complex, right? They are clearly the bellwether in the industry. They're at the higher end of the pricing curve for their premium product in their mature markets. They did just take a pretty meaningful price increase, $2 on their highest end product in the U.S., which signals management's confidence in their ability to achieve those pricing-driven goals. But when I say it's complex, it is because they are growing that advertising-supported tier, which really gives consumers options with respect to how they compensate the company for the great and growing amount of content that they're putting on the service. And really, as the company grows the number of users on that advertising-supported tier, the curve sort of steepens with respect to their ability to monetize it. So it's not a one-to-one relationship, but as they grow their scale and reach within their advertising base, they can actually grow their revenue per user on that platform. So launching that service or that element of the service a couple years ago was really important for their overall ability to impact that pricing dynamic, in addition to continuing to try to grow the subscriber base.
Do you think that they're going to try to grow their subscriber base inorganically, given the fact that they were interested in Warner Brothers? Will there be another suitor potentially in the near future?
I'm skeptical that there will be. It's not something that we've written about specifically, and there's nothing really in the press to indicate that they are doing something outside of what they said was that this was a unique situation, a nice to have, not a need to have. So when we look at the key initiatives for the business right now, it is increasing their content spend. They talked about a 10% increase. That puts them close to $20 billion of content spend this year. We're looking at diversification of how they spend. They've done more live events. They've added sports, particularly outside the U.S. We do think they're looking at potentially expanding their NFL relationship inside the U.S. and different types of content, right? They have some of this podcast content. They've expanded the games, and they are expanding a live partnership in Europe in the French market this year. That should be rolling out later this year with TF1. There really could be a template for more partnerships that they could do broadly in the future. So the core business is strong. We think it's healthy, but we also like the potential for another gear that's really not yet in the numbers or expectations for the business. And I think they can achieve that without needing to make an acquisition. But Netflix is sort of famous for the never say never approach when they give us some guidelines for how they're looking to the future.
Just quickly, how long, Michael, before we get commentary from the likes of Netflix saying they're lowering their production costs by using AI?
Well, I think it's as early as today, right? So I think that Netflix has been very clear that the use of AI is going to be part of their process, but their view is not disruptive to the creative process. So they're still very focused on being creator friendly. I think not just to be sort of good corporate citizens, but they do believe that human created content and artistic content is core to what they put on the platform. That said, there are opportunities throughout the process to enhance the product using AI features for things that perhaps were more costly and more time consuming in the past. So they made an acquisition during the quarter of a business that allows them to do much more production and post-production related projects or processes in a more efficient way. And it's early days, so we look forward to hearing how the company expects that to benefit them. But it is absolutely part of their process, and we will be hearing more about that.
Michael, good to see you. Looking forward to the results a little bit later. Michael Morris there of Guggenheim Securities. I've seen some good content over the past few weeks, haven't you?
Netflix.
No, from AI.
Oh, from AI. Oh, yeah, AI is all over.
Some pretty good stuff.
All over Twitter. It's amazing.
We'll get you some data up next. Jobless claims. Plus, we'll catch up with Jonathan Pingle of UBS. Live from Washington, D.C., from the nation's capital this morning for the IMF World Bank spring meetings, at least for the next 24 hours or so. Temporarily had some people reaching out about the studio.
Well,
so
yes.
They preferred the New York studio.
What you mean so that we don't have to go, hello,
yes,
how are
yes.
you? Well, it's okay. It's just a couple more days.
Different flavour. We'll be back in New York in a couple of days. All right. Let's get you some jobless claims. Some data just crossing in just a moment. Equity futures positive going into that. We're up by 0.1% with that economic data. Enda Curran has the numbers for us. Good morning, Enda.
Yeah, good morning. Jobless claims of 207,000, Jonathan. That's below, actually, the market estimate of 219,000. So it speaks to the idea that the employment market continues to be one of low hiring, low firing. These numbers lean into the stabilisation theme. There can be volatility, of course, at this time of year with the Easter break and with spring break, etc. But just having a quick glance at the headlines that I saw coming out there, it does speak to the idea that the jobs market is finding its feet. And remember, the backdrop was the official data for the month of March, that we had very strong job gains, broad-based, unemployment rate falling. So I don't think these numbers this morning would necessarily lean into a near-term dovish case for the Fed.
207 is just absolutely phenomenal. Enda, I just want to sit on the 207. I know this is a low hire, low fire jobs market, but 207K, can you frame that for us, Enda, for people that maybe don't follow the labour market as closely here in the US, just how low that number is?
Well, it's historical lows, Jonathan. I don't have the exact size and scope for you now, but I know it is historical, and it speaks to the idea that despite, all of the concerns around the economy with price pressures, with the oil shock story, etc., the jobs market continues to hold up, and as long as that's holding up, it's good for the consumer. The big question, though, is going forward, will we start to see the impact from the diesel costs, from the fertiliser costs, from the gasoline costs, and will that start impacting business budgets and the households, and will they rein in their spending? And by extension, will we see a hit to the labour market in the months ahead? We don't know yet because we don't know how the war will end up. But right here, right now, by all accounts, the jobs market, which the Fed said in January, by the way, is clearly showing signs of stabilisation.
Enda, it's good to see you. Thanks for breaking it down. We'll catch you a little bit later. Enda Curran there, breaking down the latest jobs number. Jobless claims at 207. The estimate was 213. This is down on the previous week as well. And every time we talk about jobless claims and continuing claims, what do they speak to? Low hire. You see that in continuing claims. If you're out of a job right now, it is hard to get a new one. Low fire. You see that in initial jobless claims. Every single week, Lisa, we've been talking about the same thing for a number of weeks now. Going back, I would say more than a year.
Yeah, and on one hand, some people could say this is a sign of strength. A lot of people would say this is a sign of strength. Just to give you a reference point of how low it is. From 2010 to 2019, the average was 306,000 per week, just to give you a sense of the initial jobless claim. So this is substantially below that. On the flip side, you could say this is a supply-side issue, and this really is a demographics issue, given the fact that we've actually seen a contraction in the population for the first time since the 1950s in the United States. So how much is this a supply-side issue that, ultimately you need your workers, even though you might not want to expand, even though there aren't that many jobs that are prevalent for people who are out of work?
On that point, Jonathan Pingle of UBS Investment Bank joins us now for more. Jonathan, good morning. Good to see you.
Good to be here. Thanks
I think
very much.
the point that Lisa's making is a really important one. We've been talking about a series of negative supply shocks. The more recent one is the energy shock in the Middle East. The one that's pertinent to this conversation is the labour market shock. A massive negative supply shock. What is the break-even rate for this jobs market right now?
Well, so we've got a bunch of estimates, the break-even rate, because you can do it a lot of different ways. But, we would expect the break-even rate is probably about 25 to 50,000 jobs a month. We have had a big slowdown in the immigration flows across the southern border. We've seen an increase in exit migration. Now, there are a bunch of open questions for the coming year. This might be a little in the weeds. The Trump administration through September actually was approving legal immigrant visas at a 600,000 annualized pace. And that had not really fallen off since the Biden administration. This year they've tried to put in place sort of other restrictions on family reunifications, et cetera, that could make that worse. But I think if you look at the overall array of economic data on the labor market, where we have seen work weeks pull back, if there really was people not showing up for work, you'd expect existing workers to work longer hours. So I do think there has been a pullback in labor demand. There's probably been more than the drop in labor supply here. But, we're certainly living in an environment where we've had really low job growth, and yet the unemployment rate's basically been stable for the last year.
So this is the important question, and we've asked it a number of times over the last 12 months or so. We've seen a real deceleration in payrolls, but have we seen a corresponding increase in labour market slack?
Over the course of the last year, yes, we have. If I look at things like whether it's what we've seen in people out of the labor force, if I look at work weeks, and even the unemployment rate itself has edged up over the last year, but not in any kind of alarming way for the FOMC. But we do have to think about some of these other margins of slack. If the participation rate last month had not fallen back, the unemployment rate would be 4.51%, and we'd be having a somewhat different conversation. Now, I think the other caveat to that is the extraordinary volatility we've seen in the labor market surveys year to date. Non-farm payroll employment swinging up 160,000, down 133, some of that due to the methodological changes. And if you look at the household survey, March had the lowest all-time survey response rate. So you've basically got, 40,000 households being interviewed, trying to be representative of a nation of 334 million, right? But smoothing through all of that, it does look like there's been on-net slackening since, sort of January, February last year.
And one of the key data points that people point to represent that is the wage increases, and they've actually slowed. And you've seen the slowest pace of wage increases, I believe, going back to 2021. And I just wonder how much power the labor market has, how much power employees have to ask for raises in response to the increase in commodity prices, the increase in inflation, et cetera.
Well, Lisa, you were talking about this earlier, right? You were talking about corporate profits and the share. So, essentially, if you flip that around, that calculation you were talking about around, right, you're talking about sort of labor share of national income, and it's sitting near all-time lows, because of sort of the lack of bargaining power. And I think this goes to the fact that, even with the reductions in labor supply, it does not look like an overly tight labor market. Most FOMC participants are not, even the hawks are not saying the labor market's a source of inflationary pressure here. But yeah, you've got average hourly earnings in real terms below sort of the expansionary levels post GFC. So, it does not look like we've had some sort of fundamental shift in bargaining power here. And in a service sector economy with a lot of bilateral contracts, low levels of unionization, I mean, we can sort of see that nominal wage growth has slowed and workers don't have a lot of power here.
At what point does this break down? The idea that you have corporations that are building their market capitalization and their profits at a disproportionate pace, at a record pace relative to the employees' share of it. At what point does that create a fundamental problem for the economy?
Well, welcome to Washington. I mean,
This is the truth, right?
We're living in this world of gridlock, populism. I mean, you've hit the nail on the head here, Lisa.
Okay, but when does it have an economic read-through? I mean, when does it have something that comes out in Wall Street earnings, in Wall Street parlance, where people start to care on the economic side?
Well, this does come through in economic parlance. If I walked around our floor of equity analysts at UBS, not all of them are telling super strong economy stories. If you look at certain segments of the consumer, remodeling, I mean, we can talk about what's happening in the AI-related tech stocks, which are driving a lot of the investment and growth in the economy. But it's not all puppy dogs and rainbows out there.
When it comes to gridlock, how are you thinking about the Fed on May 16th?
Oh, that's a good question. I mean, it is going to be unprecedented territory. There is a gap in the law that it's somewhat debatable on what you think the Vacancy Act says. But, Chair Powell certainly has staked out, both his intention and what he thinks is the legal basis to stay on until Kevin Warsh is confirmed. I think he will have a fair amount of support on the committee and amongst the Republicans in Congress for that stance. But I think the real open question also is whether the Department of Justice probe gets resolved. But it does look like we're going to have this gap where Chair Powell's term ends May 15th, and there's not going to be the nominee just entering the building.
The other question is, do you think he stays on as a governor?
I think he stays on as a governor until everything's really fully resolved. I think that he does have a fair amount of support on Capitol Hill. And to his credit, as his time as chair, I mean, one of the reasons he's got a lot of deference from his committee is because he has spent a lot of hours pounding the pavement on Capitol Hill for the sake of the institution. And I think that's brought a certain amount of goodwill from both parties. So I think as long as there's this, sort of lingering political risk, I think he's going to want to stay on as governor just in order to, maintain that kind of political economy.
Is this making Kevin Warsh's job harder?
I don't know if it's making Kevin Warsh's job harder. I think Kevin Warsh was going to inherit an already difficult position with an institution under pressure. And we had the conversation last time about what happens when, President Trump's nominee sort of inherits the economy, and there's an ownership to that. But I mean, they haven't hit the inflation target in 5 years.
Right.
The labor market doesn't look all that great. So I think it's a tough job for the FOMC participants generally, and I think it'll be tricky for Kevin Warsh, but I think that would have been the case for any new Fed nominee.
Final question: which Pingle is winning this year when it comes to job guesses?
Oh, me, of course.
Yeah, you've been the young one. There we go. All right, Jonathan, good to see you. Thank you, sir. Jonathan Pingle there of UBS Investment Bank. Can you imagine that every Christmas, getting around the table at the Pingle household?
You think it's just Christmas?
I thought it was every weekend.
It's quarterly.
Oh, 100%. I think
Junior won.
I think that would be great before every payroll.
Didn't Junior win last year?
He actually bailed and went to a hedge fund mid-year. So he's exited the competition. He was winning for a while. I regained first.
So you've won because he's bailed and he now works at a hedge fund. Okay. That's an important detail.
Yeah, that is a very important detail.
Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, standing by with more is Isabel Lee. Hey, Isabel.
Hey, John. So taking another look at the data we just got, jobless claims coming in just slightly below estimates at 207,000 for last week. The 4-week moving average holding at 209,000. Continuing claims ticking up slightly, coming in at 1.81 million. And recapping the Pentagon briefing, Defense Secretary Pete Hegseth maintaining the U.S. will continue to blockade on Iran for, quote, as long as it takes. The secretary urging Tehran to, quote, choose wisely as both nations weigh extending their temporary ceasefire and holding additional peace talks. The Trump administration is looking to have U.S. car manufacturers play a larger role in making weapons. The Wall Street Journal reporting that the Pentagon approached top executives at GM and Ford about producing military supplies. The talks come as U.S. officials grow more concerned about domestic manufacturing capacity. That's your Bloomberg Brief. John?
Isabel, thank you, and thank you for this morning. Up next on the programme, Mona Mahajan of Edward Jones with stocks heading for another record-setting day. Plus, we'll touch base with Danny. She's got some morning movers for you. Flutter shares dropping in the pre-market on a double downgrade. That stock is down by 2.4%.
There is a short-term look-through in the markets, especially the equity markets, as to the prospects of both the war ending quickly and exuberant spirits and investments and IPO calendar and deals. That's what keeps the stock market going. But in the background, humming slowly, are the long-term consequences, which is what will give central banks, pause as to how they deal with this situation.
Always great to touch base and catch up with the Barclays CEO, CS Venkatakrishnan there. In a quiet period, so no conversation about the earnings, but just a feel for some of the challenges right now and the opportunities. The challenges clearly present in the Middle East. The opportunities clearly present in the United States. The pipeline, the IPO calendar. Things are really stacking up, Lisa, for the 12 months ahead of us.
Talking about some of the biggest IPOs ever in the history of the United States, we could end up seeing something from Anthropic and then OpenAI. Who's going to get it first? We can talk about that. SpaceX. And frankly, nothing has derailed that. Right now, all people are looking for is a sense of things not getting worse and some cone of stability, as Ted Pick was talking about, in order to get these deals across the line.
I still laugh. Remember when people used to talk about unicorns?
Yeah.
And they were billion-dollar companies in private markets,
Cute.
startups. Cute, right? $2 trillion for SpaceX, potentially, which is crazy. These companies have stayed private for so long because they can, because the capital is available for them, the opportunity's there. And now they're coming public. These valuations, these market caps, just ginormous, unthinkable more than a decade ago.
Yeah, and it transforms the dynamics in markets. If you think about it, the overall stock portfolio has actually been shrinking as as a share of the economy going forward. Suddenly it's going to expand. So we'll see some interesting dynamics under the hood, too, as these companies need to cap that much more capital going forward.
The opening bout just around the corner, about 43 minutes away. Equity futures doing OK, up by 0.1%. Let's get you some single names, some morning movers. Danny Berger's back with us with more. Hey, Danny.
Hey, John, looking at a market that's up today, and so is Hims and Hers. RFK Jr. announcing that the government was looking at removing some restrictions around peptides, specifically Category 2 restrictions. Basically, what all of that means is if they were removed, it would be easier to both prescribe and sell peptides. Great news for Hims and Hers, because literally just in February, they acquired a California plant that produces them. So shares are up a nice almost 7.5%. Elsewhere, some sell-side action. Bad news for Flutter, a double downgrade from Citi. In fact, they lowered their price target by 57%. This is a stock that's already lost half of its value. They warn about greater competition, and especially from prediction markets, and that they might lower their outlook when they have their 2026 earnings. So shares are off 2.6%. Finally, PepsiCo, they were out with earnings this morning, beat basically everywhere thanks to lower prices. They've lowered prices by about 15%. Most of their sales, though, the real growth came from international markets. They've been facing pressure from Elliott Management. Some of the majority of gains coming off a little bit. They're now just up 0.4%, and also announcing a new and healthier Gatorade for health-conscious consumers. Apparently lower sugar and more hydration. So there you go. PepsiCo slightly higher this morning, John.
We'll take that. Danny, thank you. Thanks for the update. Looking forward to the programming with Danny and Matt Miller in about 11 minutes' time. A new, healthier, upgraded Gatorade.
Less sugar, but more electrolytes. I think that's a win, right?
Honestly,
I think Pedialyte.
I think the Pepsi story is fascinating because they cut prices. And that's one way that they actually generated revenue, because they raised their prices way too much. And so then they had to retrench, and they're gaining it by volume. Frito-Lay's, it's sort of like they're barbelling their approach. Frito-Lay's and then a healthy energy drink, and somewhere in between, they'll get all the customers.
You're excited about the finance, and Anne-Marie's excited about the product.
Sounds about right.
OK, as we count you down to the opening bell, let's get to the trading diary, what you need to look for going into the weekend. One more day and a half still to go. Going into the closing bell, we'll be looking ahead to Netflix results. That comes after the close. On Friday, the president speaking in Arizona going into the weekend. An important one going into the weekend because on Tuesday, the US-Iran ceasefire expires. And then there's this. A Senate confirmation hearing for Fed Chair nominee Kevin Warsh, together with results from United. Scott Kirby in the hot seat, given his interest, reportedly, for American Airlines, and Kevin Warsh as well. That Warsh hearing, must watch. Box office on Capitol Hill.
Yeah, especially given the fact that A, you've got inflationary pressures, and B, I imagine someone's going to ask him, how would you feel if Jay Powell stayed on as governor? Could you work with him? Would you recommend that? How do you feel about that? And then also, how much could you potentially cut rates down the line? And if he says significantly, echoing what we heard from Scott Bessent, you could see a real market reaction. And if he doesn't, you could also get a reaction, but it would be in the form of Truth Social.
I think it will be a quite testy hearing, especially given who Kevin Warsh is in the Trump orbit. Of course, we all know that Donald Trump is very close to his father-in-law, Ron Lauder. So there's going to be, I think, a lot of personal questions as well directed to Kevin Warsh. And then, of course, the big question is, how long does he just sit in that hearing? Basically, you can't get a vote out of committee because of what Senator Thom Tillis is doing.
One to watch over the next week. The one to watch right now going into the opening bell, a series of all-time highs at the close on Wednesday, coming into Thursday on the S&P 500 and on the NASDAQ. Mona Mahajan of Edward Jones writing fundamentals remain largely intact, potentially setting the stage for renewed market progress if we see a resolution in the Iran conflict. I'm pleased to say that Mona joins us now for more. Mona, do we need a resolution to the conflict in Iran? Is that what this rally is all about, or is it about something else?
You know, it's a good point, John. Look, I think markets are optimistic, embracing the fact that we're making progress towards a resolution. Both sides seem to be willing to talk to one another. We're making progress towards a resolution around the Strait of Hormuz. But more broadly, I'd say markets are, as we know, forward-looking, and we have a glimpse of what they're looking at. We know WTI oil futures, for example, heading towards $75 back by December 2026, by year end. And so markets are pricing in a resolution, at least some sort of mean reversion. And secondly, we know markets are looking at earnings growth, which is pointing to about 18% year-on-year S&P 500 corporate earnings growth for 2026. So really strong on both fronts. I think that's what markets are looking at, a combination of fundamentals and some mean reversion in oil.
Mona, how much is what we're seeing in terms of earnings expectations and earnings forecasts right now kind of a one-off, a perfect confluence of events that happened and was set up before the conflict in Iran that could potentially get disrupted later in the year as you start to see some of the inflationary ramifications?
Yeah, it's an interesting point because, of course, part of the upward revisions in earnings is coming from the energy sector, which, of course, is benefiting from higher oil prices. The other big part of the earnings story has been tech and tech CapEx spending in particular. We've seen upgrades in the tech earnings sector driven by the AI CapEx build out. And so, of course, to the extent that that continues, will drive earnings. But if that does start to moderate, or at least the pace of gains start to slow in the year ahead, we could see earnings growth start to moderate as well. But we do think overall the consumer has remained intact. And in fact, what's interesting, we think, from both a labor market story and an inflation story, labor market, we are seeing signs of resilience. We saw that in last jobs report. Of course, we'll see how that trend plays out in the months ahead. But to us, the inflation story has been particularly notable. We haven't yet seen, and we've even gotten March numbers where WTI and oil prices were elevated. We haven't yet seen a meaningful acceleration beyond forecasts in inflation. And in fact, core inflation seems to be moderating. So to us, that's a good margin story for corporations ahead as well.
Mona, does it make sense that the Russell 2000 is 0.2% away from all-time highs and the Magnificent Seven really isn't close to all-time highs, or is it much further away from all-time highs?
Yeah, you know, the small cap story is certainly interesting. And we know when we started the year, there was this theme of broadening of market leadership, and we saw mid cap and small cap stocks outperform. We saw cyclical and value sectors start to take some leadership. There was a bit of pause and cooling in that as the Iran conflict played out. But what we're seeing now, as we're heading towards potentially some easing in that conflict, that story has started to reassert itself, and that broadening story is starting to come back to fruition. And we do think small cap and we like the mid cap story, but both of those will benefit as the U.S. economy potentially stabilizes and continues to grow. But also, small caps in particular are going through an earnings inflection point. They've in fact had negative earnings last 2 years, and this year are expected to have positive double-digit earnings, similar to the broader S&P. So that inflection point tends to be the point where small caps do outperform. And so if that story holds, we think small caps could have a meaningful upside this year versus, broader indexes.
Just an incredible run in the US equity market. Mona, thank you for your time, as always. Mona Mahajan there of Edward Jones, the opening bell about 36 minutes away. We played this game last week. It's worth playing again. If I told you the Strait of Hormuz would be all but shut, with hardly any traffic going through it for 6 weeks plus, and the equity market would be at all-time highs, and the backdrop for that equity market were worries about AI disruption and broader concerns about private market jitters and a Federal Reserve that might not be able to reduce interest rates anytime soon, and a conflict at the top of who's going to lead the Federal Reserve in the mix as well, and would be sitting here at a record on the S&P 500, and yet here we are.
Yeah, you might actually expect someone to write a headline like either markets are dumb or the oil analysts are, which is exactly what we got from Yale Dutta earlier today, because ultimately it does seem like there is a disconnect right now. At the same time, people are saying this is a more independent economy from the commodity space, is more energy independent, and frankly, you're seeing a lot of strength in other areas as well. So it is a conflicted and difficult moment to really reconcile.
It's very uncomfortable given what you hear and see out of Asia, and also the fact that the IEA says Europe's about 6 weeks from potentially not having enough jet fuel, and then they have to start canceling flights in 6 weeks' time. And to your point, the Strait of Hormuz is still closed. I find it very challenging to look at my screen and see oil, Brent, and WTI under $100 a barrel in this scenario.
The coverage continues from Washington, D.C. tomorrow at the IMF World Bank Spring Meetings. We'll catch up with Ed Yardeni of Yardeni Research, Rick Reeder of BlackRock, Joyce Chang of J.P. Morgan, and the former U.S. Deputy National Security Advisor, Philippe Singh. Looking forward to that. Live from Washington this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.